The Fed is telling us it wants to start the easing process in the middle of the year, and it's willing to do so even if in the first half of this year it's getting uncomfortably high inflation.
They want to cut. They still firmly believe that policy is restrictive.
It is clear that the Fed is on the path towards lowering rates in 2024.
The big risk that I'm concerned about, a sustained reacceleration in inflation that the Fed cannot deliver at some point in 2024 on rate cuts.
They need to be open to the possibility that inflation is sticky, and I think that changes their communication and the rate path.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market pulling back just a touch on the S&P 500, negative by 0.1%. Wrapping up Q1, another decent month of gains on Q1. Year to date, up by 10% on the S&P 500. God bless Governor Waller. At least you get some consistency. In a previous speech, the title of the speech, What's the Rush? The latest speech, There is Still No Rush. Sometimes they can just make it very easy for us. You don't even need to read the speech after you see the title.
Which is the reason why maybe people aren't reacting more than you would expect, given the fact that he had very hawkish words to say. Basically, stop expecting all these rate cuts because I don't like what I saw. And if we see this type of inflation data continue, perhaps we have to push back how many rate cuts and when we start.
I love the balance of risk question on the FOMC. I think it's something you have to ask every single official. What is the biggest risk? Holding too long, cutting too soon? I think it was pretty obvious about it. He said the strength of the US economy and resilience of the labour market mean the risk of waiting a little longer, Lisa, to ease policy is small and significantly lower than acting too soon. The question I've got, does that argument win out everybody else on the FOMC?
And right now, if you take a look at the market, the answer is maybe. I mean, it seems like people aren't necessarily buying wholesale into Chris Waller being the mainstay of Fed governors and how they feel, Fed officials. When you take a look at the odds of a March rate cut, you're looking now at 55% versus 63% yesterday before the comments. Not a significant change. At this point, Chris Waller is a known hawk. There's still no rush for him. Is there a rush for some of the others who we'll be hearing from tomorrow in particular?
There is a rush to upgrade targets on the S&P 500, that's for sure, over the last couple of weeks. We get another one overnight, this time from RBC. AMH, Lori Calvasina, lifting the year-end price target to 5,300 from 5,150. We've seen this from a series of banks over the last few months.
Yep, she's talking about spring cleaning when she wants to lift her S&P 500 forecast. That's in her 2024 view. She's lifting that price target. But Jonathan, J.P. Morgan yesterday, they're noting, their chief global equity strategist warning banks' clients that, quote, don't be stuck on the wrong side. In case there is a pullback, you do not want to be stuck on the wrong side. Yet people continue to lift upgrades for 2024.
You know, I kind of love this. Let's just talk about, she went through her forecast. She said we lifted it from 5,000 in November. It was 5,150. Now we're moving it to 5,300. You know, it's kind of like we have to kind of do this because it's already moved so far beyond where we are, which kind of shows you what a surprise this year has been on so many levels in terms of just the strength and the continuation. It's hard to find someone bearish. And when you find someone bearish, they're apologetic and very, very self-conscious.
The rally has changed. I think we should frame the last 5 months or so and split it up 3 and 2. So 5 months of gains on the S&P 500, a move of something like 25% since the end of October. The first 3 months saw the 2-year yield drop by something like 80 basis points. OK, the last 3 months, the 2-year yield has risen by close to 40 basis points. So the first bit of the rally was all about pricing in rate cuts from the Federal Reserve. Then the second half of the rally was all about pricing out rate cuts from the Federal Reserve because the data was better. This has been 2 very different stories, even though it's been quite consistent in terms of the gains.
And if you look at under the hood, it is broadening out. I was taking a look at the different dissection. You could see that the S&P is up by 10%. The NASDAQ is up by a little bit less than that. And you could see a divergence within the Magnificent Seven. The Nikkei is the big outperformer, up 20% so far in the quarter. It's as if this isn't necessarily the same monolith that it was 3 months ago. It is a new type of bull market that people are expecting can broaden without sort of the insecurity that Chris Waller's raising, which is what if this is sticky? And what if we cannot cut it all? Because frankly, you're making it really tough.
Public service announcement, just to throw one in there for you. If you are based here in New York City, you're in the market, excited for a 3-day weekend, don't get too excited. Later on this evening, there might be a lot of traffic. We're going to get 3 presidents in the same place in Midtown Manhattan. We're going to see Obama, right, Clinton, and Biden trying to raise something like 25 million US dollars.
Yeah, that's right. President Biden out front when it comes to fundraising. He is literally crushing the former president when it comes to the dollar signs in his war chest. And he's going to be adding to that this evening because they're calling it really a star-studded event because he's going to be joined by Barack Obama and Bill Clinton to try to bring in more of those campaign donations. And Jonathan, you talk about traffic. The former president is also going to be in New York today. So there's going to be a split screen of what's going on between these dueling candidates.
These are the kind of things that get Lisa very excited.
I'm leaving town.
Are you? You're getting out of town tonight?
100% beforehand. I actually am. That sounds absolutely dreadful.
I don't think you're the only one. Equity futures right now on the S&P 500 pulling back by 0.1%. No big losses on the screen this morning. Some big gains over the last 5 months we'll get our teeth into in just a moment. In the bond market, yields creeping higher again by 3 basis points. On the 10-year, 4.22. And in foreign exchange, just slowly, this dollar strength story starting to build. The euro, 107.76. Dollar stronger. Dollar yen, the line in the sand for so many. Bramo 152. Yesterday 151.97. This morning 151.44.
Is 152 actually the line in the sand, or is it sort of the way that it gets there and whether they can just sort of allow it to drift to 152.50? I mean, these are the levels that people are talking about at a time where people just didn't buy the intervention, the verbal intervention that they had yesterday. So really, this is a show me the money kind of story. Does the Bank of Japan step up, or are they going to leave this to jawboning that seems pretty ineffective?
It's just a tiny bit of yen weakness on the screen so far this morning. Here's the next hour for you. Over the next 60 minutes, we'll catch up with Larry Adam of Raymond James as the S&P 500 hits another record high before closing out Q1. Eric Nelson of Wells Fargo as we look for intervention from the BOJ. And Constant Hunter of Macro Policy Perspectives as Fed Governor Waller pushes back on rate cuts. We begin with our top story. The S&P 500 hitting yet another record high as investors look to round out the quarter. Larry Adam of Raymond James saying the rally has room to run. We believe the equity momentum is likely to continue because we are in the early stages of this bull market. Larry, I'm pleased to say, joins us now. Larry, we talked about this last time you were on. I think we have to repeat the conversation because you're repeating the effort. Why do you think we're in the early stages of a bull market when some people keep saying we're late cycle, this is going to end, and it's going to end soon?
Well, I just look at what's been happening to this economy, and I do think that we're going to be able to avert a recession. So we'll continue to see earnings continue to move higher. If you look at the sheer magnitude of what's happened with this bull market, it's one of the weakest bull markets that we've ever had if you go back, in more recent times. And then if you look at the average duration, usually bull markets tend to last about 5.5 years. We're only about 1.5 years into this bull market. So I still think we have plenty of room to run, although I would say that I am a little bit more cautious here in the near term.
Larry, let's dissect the last 5 months together. We mentioned briefly about the relationship or lack thereof between the bond market. I just want to talk about valuations before we get into that. November, I was going back over my old notes yesterday evening. November, we were talking about being priced for perfection. 2 months later, January, we had a bunch of notes saying we were priced for perfection. And Larry, we still get guests coming on the program today at the end of March saying we're priced for perfection. We were priced for perfection 25 percentage points ago, and we're still higher. Larry, can you tell me exactly what we're priced for?
Well, I think we're priced for perfection, but that's because earnings have continued to move higher. I mean, when you came out of last quarter's earnings, you've seen a pretty significant upward revision to earnings, and that's why I think it's allowed the markets to continue to move higher. But I agree with you that earnings right now, where we are, price valuations, we are pretty expensive. We're in the top decile when it comes to PE valuations for over the last 20 years. If you take out the COVID time period, it's probably the most expensive we've been over that 20-year period. So that's one of the reasons why I'm a little bit more cautious as we sit here today.
Forgive me for being a bit confused. It's the beginning of the bull market, but you're also cautious and kind of trying to sit on your hands. Which is it?
So shorter term, again, I think you guys mentioned at the beginning of this section, the market's been up 27% over since the lows of October, right? Usually you tend to see that type of performance coming out of a recession, not going into a soft patch. But that being said, usually you have 3 to 4 pullbacks in a given year. We haven't had one in 6 months. So we're already about double the time period that you usually get a pullback. Once we get that pullback, which I think you're going to see the equity markets pull back to around the 4,800 to 5,000 level, that'll continue to set up a pretty nice run into the end of the year. But when I look at the fundamentals, I don't see earnings moving lower anytime soon. When I look at this economy, as long as that remains strong, that'll continue to propel those earnings. And I'm really not as concerned about the Fed cutting rates. I don't care if it's 1, 2, 3, 4, 5 times. I think it's more important, what's the impact on the economy? And as long as the economy remains strong, those earnings will be there.
Are you saying that if the Fed doesn't cut rates and keeps rates where they are between 5.25% and 5.5% for the remainder of this year, the market could still hang in there and remain incredibly attractive just simply because there's enough economic strength that is not necessarily a restrictive rate?
So I think if the economy were to continue to do better than what people think, that is a potential scenario. Our scenario, though, is that the Fed does start to cut starting in June. It will take some insurance cuts to make sure it increases the likelihood that this is a soft landing. Because I do think you're going to see a soft patch coming during the middle two quarters, second and third quarter, but it won't be enough to take us into a recession. It'll just be a mild slowdown to set up for an acceleration of growth towards the end of this year into next year.
Let's pair that with sector preferences, Larry. What we've seen through March is outperformance on energy, outperformance on banks, relative to information technology on the S&P 500. Tech hasn't been dominant in the month of March. Larry, would you extrapolate that out given the recovery you're expecting in the second half of this year?
No, I mean, we still like technology. I think once we get back into earnings season once again, you'll probably see those companies deliver on the earnings side. You know, if you go back over the last 10 years on average, those companies tend to outperform their earnings expectations by an average of 7%. And I think you're going to continue to see those revisions moving higher. So we do like technology. I do like healthcare, and I do like the industrial sector, because one of the things that we do believe has happened here is that we're in the bottoming process of those manufacturing indices that have been coming out. And historically, once you hit a bottom, industrials tend to outperform pretty dramatically over the next 12-month time period.
I think a lot of people would agree with you, Larry, and talk about how expensive the stock market is right now and valuations making them a bit queasy. Question is, what do you do with that? Do you hold more cash and wait for a drawdown of some sort to come step in? Do you just basically hang in there and say, long term, it's good, short term, maybe we can reallocate? How do you handle sort of near-term pessimism and long-term optimism?
So I think you keep your holdings that you currently have in the equity market. You know, we've had people that have excess cash on the sidelines. You know, with a 5% plus rate in money markets, there's been no rush to really put that money to work. But if we get a pullback to the area that we're looking for, closer to that 5,000 level, I think that sets up a reasonable opportunity, particularly for somebody that has a long-term horizon for this equity market.
The elusive dip that everyone wants to buy. It's the elusive dip everyone wants to buy, Larry. Larry Adam of Raymond James. Larry, thank you, sir. The elusive dip, Bramo, because we haven't really had one for 5 months.
Exactly, which is the reason why I kind of wonder how people handle this type of thought, because truth be told, a lot of people have it. Valuations make them feel a little sick. But at the same time, it's sort of hard to not buy if you see not a lot of gray clouds. If you're not worried about the Fed, and if you're not worried about weakness, and if you're not worried about, the boogeyman coming out of the corner, what's going to really cause that drawdown?
Everything people were saying about valuations, same story, 800 S&P 500 points ago. We kept repeating the same line the whole way up.
Which is the reason why momentum is a hard trade to bet against. And that's what we keep hearing from so many people, which is why I can get over its skis. Maybe we're just not there yet.
Matt Miskin, later on in the programme, is going to weigh in on that exact point. Equity futures on the S&P 500, negative, little softer, but no real drama here. We're off the lows. We're down by 0.06% on the S&P. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Former crypto mogul Sam Bankman-Fried will be sentenced today over his role in the 2022 collapse of trading platform FTX. Bankman-Fried was convicted back in November of fraud and conspiracy, with a jury finding that he illegally used money from depositors to cover personal expenses, including the purchase of luxury property. Prosecutors recommending a prison sentence of 40 to 50 years for Bankman-Fried. His family and friends urging leniency, saying FTX investors have largely recovered their funds. While UBS cut its bonus pool last year by 14% after a tough year for traders and deal makers, its CEO now ranks as the best paid European bank boss. Sergio Aramati received $15.9 million in compensation for his first 9 months in the role. He was brought back as CEO in April last year to oversee the bank's rescue of Credit Suisse. UBS reported a record annual profit of $27.8 billion, largely driven by windfalls from the takeover. Major League Baseball's owners unanimously voted to approve David Rubenstein as the new controlling owner of the Baltimore Orioles. The franchise has been valued at $1.7 billion, with the co-founder of the Carlyle Group taking a 40% stake with the option to buy the rest of the team when longtime owner Peter Angelos died. Angelos passed on Saturday, but Rubenstein has not yet spoken to the family about purchasing the rest of the team out of respect. That's your Bloomberg Brief. John?
Very, very cool. Yahara, thank you. I understand it's opening day tonight, right? So they've done that just on time.
Yes, and a number of teams are actually doing their opening day over in Korea, which is sort of interesting. It sort of highlights the increasing Asian
I've seen that with the NFL
impulse.
in the UK as
big
well.
Time, which is the reason why people think that the Los Angeles teams have an advantage with getting good players because they have a good time zone for.
Do we support the Orioles now? Is that a team thing?
I don't know.
So like Yankees over here, Mets over there.
Yeah.
I guess it's up to you.
We're going to do the game. Yes, we are.
Yeah, Subway Series.
Mets Yankees a little bit later on this year.
Maybe.
We'll make that happen. Up next on this program, traders eyeing possible intervention from the BOJ.
I think when you have a very low volatility world that we do in FX, and we're always looking for the carry trade, you've got another potential funder.
That conversation coming up next, live from New York City this morning. Good morning. Closing out the quarter, closing out the month, equities just a little bit softer on the session, up big time over the last month and quarter though. Over the last 5 months, up by something like 25%. Equities negative by 0.06% on the S&P, yields up by 3 basis points, 421.80 on a US 10-year. Under surveillance this morning, traders eyeing possible intervention from the BOJ.
They laid the groundwork in terms of how to think about their policy when they dovishly hiked to zero. The rate differentials around the world still remain fairly robust. I think when you have a very low volatility world that we do in FX, and we're always looking for the carry trade, you've got another potential funder that, since they've taken out kind of that big gap from the perspective of if they actually aggressively approach policy, which they didn't.
Here's the latest this morning. The yen steadying after reaching its weakest level in about 34 years. Traders now eyeing 152, a level that many expect would prompt intervention. Eric Nelson of Wells Fargo saying this: the more sustained turn in dollar yen relies on the US side, particularly now the BOJ hike has come and gone. Eric Nelson joins us now for more. So Eric, are you saying that words are insufficient, words are not enough?
That's exactly right, John. Just because we have this intervention threat hanging over, and we are seeing maybe some shift in leadership on the funding side, funding currency side, with Swiss franc maybe coming to the forefront, it doesn't mean you should buy the yen. We really need to see a very clear turn in the U.S. and/or the global data, and a turn toward the market pricing and significantly more rate cuts. And right now, if anything, the market's moving the opposite direction with regards to the Fed.
So, Eric, when you take a look at the implications of this, are you basically saying that they don't have the guts to come in and actually do real intervention at 152, and that they would accept 152 or even 153 as long as it's controlled?
Well, Lisa, I think 2 points to make would be, first, it's not just about levels. It's also about volatility, right? You look at realized volatility, basically how much the currency has moved intraday over the past few weeks. Dollar yen has been pretty subdued in terms of its daily moves. Now, if we break through 152 and we suddenly get to 155, say, in a couple of days, I suspect they will actually intervene. They will put their money where their mouth is. But if we move very gradually, they don't necessarily have to do that. And I think that's a really important distinction. It's not just about what level we get to.
So what's the thinking here in terms of why it's okay to have this kind of weakness? They don't care about the kind of import inflation that people previously were talking about?
I wouldn't say that they don't necessarily care. I'd say that the domestic price pressures are still very well behaved. We've obviously had a lot of strong wage numbers from the annual wage results. But if you look in aggregate, wage growth in Japan is running around 1.5%, 2%. It's not running away from the BOJ. They're okay to tolerate a little bit of yen weakness here in the short term, particularly if they can avoid the opposite problem. Right? What they're really worried about is the yen strengthening too much on the back of this, normalization. I think they're very happy with the recent yen price action, given the magnitude of the change they made. So for right now, they're happy to tolerate, again, very modest, gradual weakness as long as it doesn't run away from them.
Well, if they do intervene, like you say, they could at some point. What's the base case of what that intervention actually looks like?
Well, see, this is an important, really important detail here, Annmarie. I think in terms of the actual sort of movement in dollar yen we could get, you look back at 2022, we obviously had two big periods of BOJ, MOF intervention. we're looking at 4 to 5, and sometimes even larger moves, 4 to 5 big figure moves in dollar yen. So if we kind of get up to 154, 55, let's say, on the intervene, you could easily break back below 150. The question we get all the time is also the mechanism. Are they actually selling U.S. Treasuries? We've done some work on this that shows they don't necessarily sell Treasuries in advance of intervention, but oftentimes they're using cash on hand, selling Treasuries after the fact, and using the proceeds to sort of replenish their cash holdings. It's a bit of a nuanced distinction, but important in terms of how it affects the U.S. And, frankly, global bond market.
Interesting. So, Eric, let's talk about the U.S. side. You talked about the dollar side of the trade and the importance of it. So many people on the program at the moment bullish on the U.S. The word we hear a lot of, exceptionalism. I want to understand from your perspective whether there is greater scope for positive surprises, given that it appears to be, at least relatively speaking, a high bar in the U.S.
Yeah, this is an important distinction, John. I hear a lot of people, a lot of clients talk to who tell me the U.S. economy is booming. I don't think that's necessarily true. I think it's done better than anyone would have expected, given the level of real rates, certainly the Fed included. The problem here is that it's just not slowing as much as the Fed or others had expected, and that's what's really hard for the bond market to digest right now. So if we look ahead to next Friday's jobs report, if we get another pretty solid report, even you don't have to have a 300K number on jobs. Let's say you get 210K. The market is going to have a really hard time, rallying significantly on that number. I'm talking about the bond market here. And so that's going to be a challenge for dollar yen. Coming back to the dollar picture, no one wants to get really short the dollar right now. We're probably late in the global cycle. There are some risks on the horizon. And so we're recommending in the G10 space against the yen and other foreign currencies in G10 space, being long dollars over the next 3 to 6 months for that reason.
Including against the euro, Eric?
Yes, and if you look at kind of historically, this realized, this very low volatility regime that we're kind of stuck in right now tends to be a good leading indicator for 3 to 6 months out, broad dollar strength. So I think the euro is vulnerable over the next 3 to 6 months, particularly as those U.S. election risks come more into light. We know, the Trump team has been very critical of Europe. So there are some risks out there that are building that could be dollar positive.
Eric, thank you, sir. Eric Nelson there of Wells Fargo, looking for a dollar that gets a whole lot stronger. The euro breaking down to about 107-ish.
To me, the fact they said that we're late in the global cycle and that basically you're going to get dollar strength as we're late in this cycle. And then you have Larry earlier saying that we're early cycle.
I know.
It gives you a sense. I mean, if your head is spinning, welcome. It's been fun.
And Governor Waller alluding to, not exactly saying it explicitly, that you might get some mid-cycle rate cut adjustments, 1, maybe 2 here and there. Doesn't sound like end-of-cycle type stuff over on the FOMC either.
I keep going back to this panel where I said, where are we in this cycle? And one person said late cycle, one person said early cycle, another person said, what is a cycle? How do we even know that we're experiencing one? Maybe it's sort of a bifurcated.
It got all existential on you.
This is the moment we're in. Everyone's a little existential. How do you benchmark to a time where we've got rolling cycles?
Let's talk about the BOJ just briefly. It's a very difficult position they're in when it's not the priority to stop the weakness. And we mentioned this yesterday. I was thinking back to 2011 and the S&P. The priority was to stop the Swissy from strengthening. And once you know it's the policy priority of a central bank, it's hard to fight that. I think to 2014, when the ECB was fed up of having a strong euro, fed up, sick to death of it, they come out with negative rates. It's hard to fight the ECB and Draghi at the time because the policy preference was to do something about it. I don't think we can sit here this morning and say the Japanese policy preference at the moment is to do something about dollar yen. There's a much bigger story playing out over there.
What Eric said was they're happy with the different price action. Actually, they don't mind the weakening in the yen because it allows some sort of ongoing reflation that they've been looking for. To me, this is a new way of looking at it. Not only are they not committed, to your point, they actually like what they're seeing, and they're not going to try to stop it.
That could change, of course. That's just where we are right now. Coming up on this program, Stephen Center of Kia America on the auto and EV outlook. That conversation just around the corner. Equity futures on the S&P 500 to close out the month of March and Q1. Equity futures down by 0.04%. We are essentially unchanged. From New York, this is Bloomberg. Welcome to the program. Let's check out the price action together. Equity futures on the S&P 500 slightly negative, with the emphasis on slightly. We're down by 0.03%. Far more instructive to think about where we've been over the last 5 months or so. Sitting at all-time highs yesterday. I think yesterday the 21st record high of the year so far. We have had 5 months of gains over those 5 months since the end of October. Lisa, stocks are higher by 25%.
Even though bonds are down, even though we've seen yields climb and prices come down, with this expectation that you're not going to get rate cuts, that is the conundrum. What could potentially stymie a rally that was initially on the idea of rate cuts that's now being fueled by pure strength?
Bonds down, yields up. Check out the bond market. 2-year, 10-year, 30-year. The 2-year has risen so far this year over the last 3 months by close to 40 basis points. It's up by another 6 basis points this morning, 462.41. And Lisa, exactly to that point, we have rallied over the last 3 months with high yields. We rallied over the previous 2 months to close out last year with much lower yields. And we're still trying to work out exactly what the relationship is between the bond market and stocks, given that people thought when we priced out rate cuts in 24, stocks would be heading south, not going north.
You ask 3 people that question, you'll get 6 answers. My takeaway is that essentially it doesn't matter. This is the latest sort of zeitgeist, to use Tom's word. It doesn't matter if they only cut once or if they cut 3 times this year, as long as they cut a little bit because that's their direction. And if they don't cut at all, then it becomes a potential risk. That's essentially the message that we've gotten from a lot of people. I'm cobbling it together and butchering it, but that's my sense.
The growth policy mix, we're told, is still good. They have a bias to cutting and not hiking, and the data's okay for now.
Yeah.
PCE comes tomorrow morning. Chairman Powell a few hours after that. Let's check out foreign exchange. The euro breaking down just a touch. Dollar stronger, euro weaker, 107.88. The yen just a touch weaker, a hint of weakness, 151.39. And we're told repeatedly, I don't know where these numbers come from sometimes, but 152, line in the sand, apparently, for intervention from the BOJ.
And now people are saying, is it really the line in the sand? And this is what we heard from Eric. It doesn't really matter if it gets to 152 as long as it's not rapid. It's sort of slow, controlled climb up. That's fine.
Got to 151.97 yesterday, and they just talked about it.
This could be problematic.
It's going to matter if they get to 152, maybe. Not for me to say. Under surveillance this morning, a salvage firm is now heading to the port of Baltimore to recover the container ship Dali and the collapsed Francis Scott Key Bridge. Federal officials telling Maryland lawmakers it will cost at least $2 billion to replace the bridge, including cleanup. There is still no timeline as to when normal port operations will resume. Insurers facing as much as $3 billion in claims, with Lloyd's of London the most exposed, according to Barclays. AMH, this is what we talked about yesterday. Where is the liability? Where does it sit?
Right. And what we heard from U.S. officials, we heard from Treasury Secretary Janet Yellen yesterday, is that, yes, there's obviously going to be some sort of liability on these companies and the insurance companies, but that gap, or potentially waiting for all this paperwork to go through, they say the federal government is going to step in, and we got this $2 billion floating around now. But when you talk to a lot of people, they say this could just be the start of how much this will actually cost.
It takes time to get the money, Bramo, and they need that money quickly.
It takes time to actually remove all the metal. I was reading about the excavation effort and how you get some of this material out to even begin to understand what the mooring is going to look like for the new bridge. I mean, it's really an intense process. I find that fascinating, the excavators that come in and have experience with this.
A 1,000-foot boat, ship, stuck in a bridge. That's not something you clean up overnight. That can take a long, long time, weeks, maybe even months.
And there are 56 containers still on that ship with hazardous materials in there. So they have to get it out without spilling anything. And they have to make sure to do so while preserving any type of effort that could potentially lead to a faster construction of the bridge. Highly complicated.
A massive effort underway in Baltimore. Let's turn to our next story. Fed Governor Waller looking to reduce the number of rate cuts this year or push them out even further. Speaking from the Economic Club of New York, saying, quote, I see economic output and the labour market showing continued strength, while progress in reducing inflation has slowed. I see no rush in taking the step of beginning to ease monetary policy. Waller going on to say we need to see at least a couple of months of better inflation data. No rush. That's literally his tagline at the moment over the last few months.
That's pretty interesting. Makes headlines, gives people a little bit of nerves, but not necessarily that much. But it does set up the drama for tomorrow when we're all off, when Jerome Powell is going to be speaking and when Mary Daly of the San Francisco Fed is going to be speaking. If they double down on this message, expect a bigger response in markets. Right now, people can sort of shrug off Chris Waller as a hawk. They can't do that if you hear it from Mary Daly and Jerome Powell.
Won't it be nice tomorrow just to hear from Chairman Powell and markets closed, just sort of listen to it, take it in, think about it, have a few days, come back Monday?
Is that what you're doing tomorrow?
Listen to Chairman Powell Oh, of course.
Yeah.
I'll be listening to Chairman Powell. Mike McKee's going to break down PCE for me.
He is, and I'm going to listen to it
on
too.
Bloomberg Radio, so
Wow.
I'll be tuning in for that, no doubt. Let's talk about the tension between China and the United States and a sprinkle of EV as well. Treasury Secretary Janet Yellen slamming China's use of subsidies to boost industry. Secretary Yellen speaking at an event in Georgia yesterday saying US manufacturing is facing pressure from cheap imports flooding the market. The comments ranging from green energy products to electric vehicles. Yellen saying this will be a key issue during her next trip to China, which is expected in the coming weeks. Stephen Center, COO and Executive VP of Kia America, joins us now for more. Steve, good morning to you.
Good morning.
Let's talk about EVs. It's fantastic to have you with us, sir. You've got the EV9, the EV6 over at Kia. Can we just start with how they're selling? Because we've heard a lot about pushback in this country. How are they selling?
They're selling very well. We'd like to sell more of them, but I think there's been a lot of expectation about the rate of the transition, and that's unknown. And consumers are buying the car, they're enjoying the car. The infrastructure is the challenge. The whole industry has already received the business from the early adopters. And now we're getting into people that really need the car. This isn't a toy. They need to get back and forth. The thing about range anxiety is true, but it's more about charging anxiety because the cars will go 300 miles, and very few people drive 300 miles at a time. So we're very excited. EV9's won a lot of awards. It's proven what you can do with electric cars, a 3-row SUV with that kind of range.
What are dealerships telling you about what they need right now, where consumer demand is, and how can you meet that demand?
Well, when you talk to dealers, their first answer is discounts, and that's not selling from strength. I think what we need is better infrastructure, and that's where all of this is failing, in a sense, because you can regulate what we build. You can't regulate what people buy. And the big projects like infrastructure that in the beginning are all cash out and then the return is over a long period of time, that's kind of like building highways, and that's what the government should do. And they've really blown it on that.
From a personal perspective, when I was buying a car, it wasn't range anxiety. It wasn't charging anxiety. It was resale value anxiety. And the fact that it was probably going to plunge off a cliff if I got an electric vehicle, because right now it's not clear, especially with an 8-year battery lifespan. Mm-hmm. How do you address that? The fact that these cars are not as valuable when you resell them, and potentially there could be new technologies that come down the pike in that time.
Absolutely. And when you're buying electric cars, they're probably more like tech products than they are normal cars. Perhaps the ownership method's going to change, and you may lease the car. You may be the first lessee on the car. It may come back at the end of the lease and get a complete refitting and a tech upgrade like an aircraft does, and then there'll be a second lessee, and you recondition the battery. So there's a lot of change coming in terms of how you do things, and it might be that you don't own them. And in a sense, you don't own a car when you buy it. You only own the life of the car.
You know, John's been on this point for a long time, and he's absolutely correct. It raises this question if policymakers have gotten it wrong. If basically the car makers were pushed into manufacturing vehicles where there wasn't the demand yet, and it wasn't clear that that was the right pathway, when there could have been better ways to get to a more efficient future. Is that accurate?
Absolutely. We're being told what to make specifically. And there's many ways to skin that cat, so to speak. And if you talk to engine designers and emissions engineers, there are many things they can do to clean up the cars. And there's different technologies. Batteries one, there's fuel cells. And hydrogen fuel cells are really wonderful. Their emission is water. And they're silent, and the question is where to get the hydrogen. And I've worked on hydrogen cars for a long time, and that infrastructure is even less mature than the battery charging infrastructure. So I tell everyone that I can find in the government, you need an Oppenheimer moment. And you need to feel the crisis, and you need some leadership to manage the change.
The U.S. government now has subsidies for the EVs, and then the EPA, many people say this is basically a mandate. These are the strongest pollution standards we've ever seen in the United States. So what should have they done first? Because it seems like what you're saying is they got it backwards.
Yeah, well, there's a lot wrong with the regulation. And if you think about it, you've got 3 different groups regulating the auto industry, at least 3, at least from the emissions. You have NHTSA, which is regulating CAFE, which is a fuel economy. You have EPA for exhaust gases. And then you have California steering from the back. And they're requiring electric vehicles. And there's other states that jump on that rule, and they're not doing anything about the infrastructure. And the challenge you have is you've got too many sets of conflicting rules. And in the case of electric vehicles, the point is to reduce the CO2. And CO2 is not a local problem. When you fly over the country, you don't see the lines on the ground. It's a global problem. So California is a big EV market. You know what, like the number 3 and 5 are? It's Texas and Florida. They're not ZEV states. And my attitude is, well, let people buy them where they want to buy them right now, and let's get the job done. So tell the automakers the percentage of EVs you have to sell, it's for the whole country. Don't create these silos and buckets. That's killing the industry, and it's impossible to manage that.
The Biden administration has been very happy with the Inflation Reduction Act, able to get over the finish line, but Trump is threatening to ratchet it back. How concerned are you about that? Yeah.
So someone asked me last night, what's the biggest threat that I see in this business? And I said it's an existential threat. And they said, oh, is it China? Is it something else? I said, no, that's competition. We're okay with that. It's government policy. And this whipsawing, we're making decisions that last 30 or 40 years when you build factories and establish supply chains. And to have the government policy change from on, off, it's nuts. It's just nuts.
It means you need to be really nimble. So can we talk about the EV plant in Georgia? Can you tell me whether that's going to be dedicated to battery-powered vehicles or not? How flexible would that plant be?
So that's a great question. The original concept is EVs, and it also includes a battery plant. So because you always want to have the big, heavy components right near the factory. It might be in the future, because you always want that factory running full speed with everything you can do. It might be we also build other cars there. Now, we have another factory in West Georgia that's been around for a long time, and we built Telluride and Sorrento and other great cars there. One of the things that we've done is we made room, and we're building EV9 there now. So and most of an electric vehicle is the same as internal combustion. At some point, it goes this way or that way. And we're building EV9. We're going to introduce it later this year. So it might be that we're going to balance the capacities with other products.
How easy is it to do that? I've tried to get some information, some clarity from GM and struggled, so maybe Kia can help me out a little bit more. To toggle between hybrids, EVs, and internal combustion engine vehicles in a single plant. How easy is it to toggle between the three?
The biggest hybrid vehicle isn't that different. So it has an engine, it has a fuel tank, it also has a electric motor attached to the engine and a battery pack. It's a smaller battery pack. An EV is a totally different beast because it's driven by electric motors at the wheels. So at some point when you're building the body and the car, it's either going to be born as an EV or born as internal combustion. And that's where the difference is. So at some point on the line, you go this way, you go that way. I think that the biggest challenge is the supply chain, because you have different parts. So you have to have different motors coming in and battery packs. But inside the factory, you're either jacking up engines or you're jacking battery packs in, and it's not that exciting.
When you talk about the supply chain, you mentioned this earlier, you don't worry about China. That's just competition.
Right.
Do you think increasingly the gating off of different auto industries, depending on the country, is problematic for your business, even if it might benefit you in the short run in terms of, restricting competition on the margins with certain areas?
Yeah, well, you don't. My background's in economics, actually, and you don't want to restrict competition because it breeds laziness and weakness. So competition's a good thing. You don't like it when somebody can beat you, and often you get beaten because of differences between the nations, and you just have to get better.
Steve, this was one of the most revealing conversations, honest conversations I've had about the automakers for a long, long time, and appreciate the transparency. The policymaker, it appears, has put you in a very, very complicated place, and we appreciate your time this morning, sir. Thank you.
My pleasure.
Thank you, Steve. Stephen Center there of Kia America. Equities right now just about unchanged on the S&P. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Former U.S. Senator and Vice Presidential nominee Joe Lieberman has died. He represented Connecticut in the Senate from 1989 to 2013 and was Al Gore's running mate in the 2000 presidential election. Over the course of his political career, Lieberman moved from reliable Democrat to centrist independent, supporting Republican efforts like the 2003 invasion of Iraq. Lieberman was 82. Discover Financial Services CEO Michael Rhodes is leaving the credit card company to lead auto lender Ally Financial. He will be replaced by Michael Shepard as interim CEO on April 1st. Rhodes has been in the role since December and wasn't expected to be at the firm long term. In February, Capital One agreed to buy Discover in a $35 billion deal. President Biden is set to raise $25 million in a single day as he campaigns across New York City. Biden is raising money alongside Barack Obama and Bill Clinton at a Radio City Music Hall event. The effort is designed to help expand Biden's already large cash lead over Republican presidential candidate Donald Trump. The showing alongside two former presidents giving Biden an institutional backing that Trump lacks due to his estrangement with big GOP names. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. The only thing I can think of is traffic, Midtown traffic. Up next on this program, Fed Governor Waller in no rush.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data.
That conversation up next, live from New York. This is Bloomberg. Inching back just a little bit on the S&P, down by 0.05%. Yields bleeding just a little bit higher, up 2 or 3 basis points. Crude higher too, up by 0.9%. Let's call it 1 percentage point higher, 82.12 on WTI. Under surveillance this morning, Fed Governor Waller in no rush.
I see economic output and the labor market showing continued strength, while progress in reducing inflation has slowed. Because of these signs, I see no rush in taking the step of beginning to ease monetary policy. In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data.
Here's the latest this morning. The Fed's preferred inflation metric, core PCE, due tomorrow morning at 8:30 Eastern Time. Bloomberg Economics expecting another hot print, calling for the biggest monthly increase in about a year. Constant Hunter of Macro Policy Perspectives, in line with the estimates, calling for a 0.3% uptick, but still expecting, quote, continued moves in the right direction on monthly data that should give the Fed confidence to cut in June. Constance, I'm pleased to say, joined us now for more. Constance, great to catch up with you. We'll talk about Governor Waller's comments in just a moment as well. Let's start with the data tomorrow morning. We've had PPI, we've had CPI. How do those two reads inform what we'll get from PCE tomorrow morning?
Sure. Well, PCE is a bit broader, but many of those inputs do feed in. And so that seasonal effect that we saw in January and then a little bit continuing in February will feed into PCE. On the good news front, we are expecting rents to finally come down. I know this has been a bit like waiting for Godot, but we are expecting that to be a significant factor as we move into the second and third quarters of this year. In addition, we are expecting vehicle prices to remain fairly soft. And then the real question comes in other sorts of services prices like insurance, which, of course, if you think about auto insurance, was heavily influenced by the rise in prices of vehicles, prices of parts, and prices of labor. All of that has moderated, and we're expecting that to feed through into vehicle insurance as well.
You said that you think that this will give the Fed confidence to cut in June. Do Chris Waller's comments change your view at all? That we heard yesterday him saying that it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data?
So a few things on that. We don't expect tomorrow's data to necessarily give them confidence. We expect data that will be forthcoming in the time between now and June to give them confidence. And it is the Fed's job to take the data pretty much at face value. I mean, you saw Powell speak a little bit about the seasonality factors, but we need to be, they need to be cautious and prudent with regard to that. And I think Waller was laying out the case for that last evening. On the other hand, the Fed is data dependent, and he also said that as the data come in, it will cause them to inform what actions they actually take.
Are you surprised we haven't seen that weakness yet, Constance? A lot of people had expected to see the disinflation in a much more aggressive way early this year. We're now seeing inflation in commodities across the board. Goods inflation seems to be picking back up, and people are worried about, some type of even housing price increases in certain regions. Does that give you pause at this conviction that the data will weaken enough by June?
So let's take those one by one. Certainly, commodity price increases do eventually feed through into PCE and CPI. Obviously, not right away into the core, and they haven't been going up. Well, there's some commodities. If you look at cocoa, you look at copper. Of course, they've been going up very swiftly. But if you look at the broad basket, not so much. If we consider rents, yes, we've been waiting for those. Yes, we were expecting those. But again, that beginning of the year data can be a little lumpy. We saw this last year as well. And then with regard to housing prices, let's remember that, the BLS disaggregates the two components that make up housing cost and housing price inflation. It disaggregates the consumption portion and from the investment portion. And so those house prices that are going up in the marketplace are not what gets fed into CPI and PCE. And so from the perspective of the Fed, actually lowering rates would likely increase housing supply at the margin, which would have an equalizing or downward pressure on prices.
Could we just sit on commodities for a moment? Because JP Morgan yesterday upping their target for oil to hit $100 a barrel. How much of a headache is that for the Fed, given the fact that something like oil has a read-through across the space when it comes to other products and goods?
Yeah, that's a great question. So if we look at oil prices on just about any metric, on a real basis, as opposed to a nominal basis, remember all these commodities are quoted nominally, they really haven't increased that much over time. They also haven't decreased that much over time. They've been fairly steady. And so, yes, that will in the near term feed through into prices. The question is how quickly we get to $100, right? If we are a slow creep to $100, we will have an opportunity to adjust. If it is a swift and sustained move to 100, that is a different story.
But if it's this summer and the market is expecting June, does that mean the Fed may actually have to distance itself yet again?
Yeah, I will just say that forecasting oil prices is a very, very tricky thing to do. And it's very possible we do get to 100. That would feed through into higher gasoline prices, which of course would cut demand for other goods and services, right? Because so many people need to use their cars to get to work. And we still have a predominant internal combustion engine fleet. Although if your previous guest has anything to go by, that'll be slowly going away. So, yeah, it could cause the Fed to pause. I don't think it's going to be the primary thing they're going to be looking at. If we're moving in the right direction on PCE and core PCE, 125 basis point cut is not going to change the trajectory for the oil market.
Constance, appreciate your perspective and opinion this morning. Thank you. Going into PCE data tomorrow morning. Constance Hunter there of Macro Policy Perspectives, following that speech, Bramo, from Governor Waller.
It's very difficult to understand how to take data at face value. Do you take it at face value when you take the seasonal adjustments out? Do you take it at face value when you just look at the path of inflation? Do you take it at face value when you know that there are certain areas that are going to disinflate over the next couple of months? This is such a fraught moment, and it raises a question of who do you pay attention to in the Fed, and are they going now on ideology more than just data dependency?
Do you think some of the hawks on them might trade an earlier cut for fewer cuts with some of the doves on the FOMC? Is that the grand compromise?
You think it's going to be like a poker table?
I'm just
I'll give
saying
you your cut and I'll raise you, no more.
The chairman seems to really value consensus. I don't think he wants to descend on that first interest rate cut. I think around June, if you get that cut, that's one way of coming to an agreement. Look, we can go earlier, but ultimately it's going to mean fewer for 2024.
Raphael Bostic set this up because he's talked about how he only wants one cut, and he's the one who said he thinks we can be one and done for a while. It's a good question.
See where that conversation heads. In the next hour on Bloomberg Surveillance, Jenny Johnson of Franklin Templeton, Mario Parker of Bloomberg News, Oscar de Bock of DHL, Luke Hickmore of Aberdeen. It's been a while. Haven't spoken to Luke for a while. Looking forward to that. Equity futures on the S&P 500 shaping up as follows, just about unchanged after another solid month of gains. This is Bloomberg.
it's pretty hard to bet against U.S. stocks here.
The U.S. growth aspects remain the strongest in the world.
I think we're seeing a broadening of the overall market, but we still like the U.S.
The effects of high interest rates just haven't done nearly as much damage as we would have thought to the private sectors.
All of these things say that there is a feeling that the market isn't invincible.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Equity futures slightly negative on the session, up big time on the quarter. Bramo, we're looking at a fifth month of gains on the S&P 500.
And gains that are finally broadening out. People have been asking for broadening out for quite a while. Well, you got it. Congratulations. You're still seeing the Magnificent Seven crushing it, up 17% so far in this quarter. But you are seeing other areas, in particular industrials and in particular energy in some of these places, take up some of the slack.
So what's the rush to cut interest rates? Governor Waller answering that for you all in a speech at the Economic Club of New York yesterday evening. No rush, that phrase coming up 4 separate times in that speech yesterday. I think that tells you everything about his position.
And it tells you everything about how people read everything the way they want to read it, because you have people coming out and saying there's no rush means they cut in June, and then they see whether they cut again. And other people say, wait a second, maybe he's saying that they don't cut at all this year. It's basically the way that this whole year has gone. We hear Fed speech, we get economic data, and then people take it and they fit it into the thesis that they had earlier in the year. And that's basically where we are right now.
More inflation data tomorrow morning, just reflecting on the inflation data we've already had. Annmarie, in this speech, recent inflation updates, disappointing. In this speech, the conclusion, delay or reduce the number of cuts in 2024.
The one thing he did talk about was a little bit softness on the retail sales, though, but then he said it's not significant evidence of a slowdown. He said that evidence is too sparse. But you brought up a great point, Lisa. All this really started with Raphael Bostic, basically saying maybe it is going to be one and done this year. I liked what Greg Valliere said. I'm going to have to put a little politics into this. He says, of course, we believe Fed officials when they say political considerations don't affect their pre-election policies. But he says initial rate cut on September 17th and 18th could be awkward. That's to say the least.
Let's just say if you're only going to go once, and let's play into that theme. If you are only going to go once, maybe it would make sense that you avoid the election period altogether.
So you've come up with this thesis that basically the Fed is like a poker table where they're trying to negotiate rate cuts and the timing. And that basically what they're consolidating around in the Ferro world is that you have the hawks. This is the Ferro world. The hawks saying, OK, we're going to cut once. June's a good time to do it. And then we're not going to cut again. So we'll give you your dovishness with the cut, but take our hawkishness later in the year with no more cuts. So I think that that's the Ferro base case right now.
I'm just listening to what they're saying. I'm just going off what Governor Waller said yesterday, which basically is the grand compromise. And he came up with this, which is either fewer or later. And I think if they go earlier, they lean into June, then you might end up with fewer. It might make sense at that meeting for that median dot to shift to, say, towards 2. I've got no idea where the economic data is going to be between now and then. I'm just listening to where the commentators are coming in, the officials and the FOMC. That seems to be the direction of travel.
If that's the case, should the 2-year be a lot higher? And that, I think, is going to be an increasing question. If that is truly the case, does that mean that the neutral rate is substantially higher than it has been in the past? And does that reset expectations, actually, oddly, in a more material way?
That's the debate that we'll have. But certainly over the last 3 months through Q1, yields have been shifting higher at the front end of the curve. Equities at the moment on the session, doing OK. No drama here. Just about unchanged on the S&P 500, negative by 0.04%. Yields a bit higher by 3 basis points, 421.80. And that really the story of the first quarter, Lisa. Just how well this equity market has stood up to yields repricing higher and pricing out rate cuts, not pricing them in at the Federal Reserve.
Yields are rising because of strength. It's the good kind of rising, and that's basically what people have hooked into. When does it become the bad kind of rising? People talk about the potential for 435 on the 10-year. There are all these levels, but the narratives, again, I keep going back to it. If a narrative has enough legs to it and is strong enough, it can persist for longer than the data can change or continue to go with it.
Just sort of market to market the commentary over the last 3 months, haven't we?
100%.
Because the last 3 months has been very different to the last 2 months of 2023. Coming up this hour, fantastic lineup for you. Jenny Johnson, the CEO of Franklin Templeton, as Governor Waller pushes back on rate cuts. Bloomberg's Mario Parker as Janet Yellen sounds the alarm on China. And Oscar de Bock of DHL Supply Chain as the Baltimore port remains cut off. We begin with our top story, wrapping up a quarter that felt like a year. Stocks posting another all-time high as hawkish Fed comments muddied the path to rate cuts. Jenny Johnson, the CEO of Franklin Templeton, saying this: we see a dovish but pragmatic Federal Reserve. Rate cuts may not occur as soon or go as deep as markets are currently projecting for this year. To talk about the whole universe, Jenny, I'm pleased to say, is with us around the table. Jenny, good morning to you.
Good morning.
Thank you for being with us. I want to start with this sort of really big picture stuff. How do you and the team think about investing over the next 10 years compared to investing over the previous decade or so? How different is this going to be?
I think it's very different. I mean, this is where I think it feels really good to be an active manager, right? Because you've just come off a decade where money was free. You didn't earn anything in the fixed income market, so the obvious place to go was the equity markets. And when you do that, you have a momentum market, and passive outperforms in momentum markets. And if you were lucky enough, you could qualify for the private markets, and then got excess returns there. Now it's much tougher, right? And I still think that actually I was listening to the two of you back and forth on the politics of where the Fed's going to go, which is all the reason why I would say the best thing for the Fed to do is to ignore the politics of the election and really look at the data. And I do think if they look at the data, I'm a believer that it's probably September. Is our first rate cuts are probably in September. And frankly, maybe 50 basis points, maybe not the 75 that people think. And it's, there are still 1.4 jobs for every one person looking for a job. Wages are still increasing. You saw a story with Europe stocks, projecting on earnings of European companies, and it's because the U.S. consumer is still strong. So, I think this next decade is going to be all about risk-adjusted asset management and active management.
You introduced the political conversation, so let's go there. You think they should ignore the politics. Can you personally ignore the politics?
I think if you're the Fed, the best thing, in the end, you can never defend yourself if you've allowed the politics to infiltrate your thinking. And so the best thing is to just be able to truly look at the data and stand by that, because no matter what they do, they're going to get criticized on the timing. So take out the politics in your decision-making process, and then you can stand by it.
That said, that's for the Fed. As an investor, though, politics actually has a very legitimate influence on markets, especially right now with industrial policy and people saying that that's just the beginning of a whole host of money where we actually have to realize that our economy is held up by nuts and bolts as much as it is by the pixels on your phone. How much is that changing your thesis in terms of how you invest, the asset classes, and where you're directing money?
Sure. I mean, I actually think that we've done acquisitions in the private markets. The change from public markets to private markets, I think, is directly related to what has been political policies. So just take private credit. Banks are not lending in the way that they used to lend. People get nervous because they say, look at this growth of private credit. But really, it's just shifted from the bank's balance sheets to the private markets. And that is a direct reaction to the capital requirements that have been imposed on banks. And so, we manage about $78 billion in private credit. You look in 2024, I think only 10% of direct loans have come through the banks that are syndicated. The rest go from the private markets. You look at the private equity market. Look, it's tough to be a public company here. You see CEOs who have the choice to waiting longer to go public. And so all of those excess returns in the early years are being captured in the private equity market. And I think, again, that's a bit of the politics that has become, imposed on public companies. And yet the average investor needs to be able, they invest in mutual funds and ETFs. Those are only investable in the public markets. And so we actually should encourage and create opportunities for companies to go public versus creating an environment where we're constantly attacking public companies.
The key executive was just on the last hour saying how basically it's hard to plan 30, 40 years out when regulation is constantly on and off like a light switch in Washington. John's asking about 10 years out. How do you look 4 years out, especially with a change of a president in next year from November?
Well, I think we probably do look 4 years out as you're making investments. I mean, the thing not to do is be a day trader where you're trying to just up and down jump. We're longer term investors. And so the investment thesis are going to be anywhere from 3 to 10 years, depending on what company they're investing in. But it's difficult. You have to look at markets. I mean, he was talking about the EV market and, as all of the politics that go behind that, you're going to be focused on all the policy that comes in. Similar to banks, honestly. It was pretty quiet for banks for a long time until you had Silicon Valley Bank blowing up, and then boom, you're in with a bunch more regulations. So you try to pick your sectors and understand how quickly the politics are going to impact the investment in the short and longer term.
Jenny, you were talking about some of the money shifting towards private markets. I believe you've overseen about 10 strategic investments and acquisitions in your tenure as the CEO. How do they complement maybe the shifts of capital in U.S. capital markets?
I mean, so our acquisitions have all been what we think are secular shifts in that. So one is, again, I talked about this private market. So, and actually, I think right now private equity is going to be sort of a challenge, right? With interest rates up, you've seen the private equity firms that have excelled. Well, when cash was free, it was hard not to do well. It's going to be a different story now. We bought secondary private equity, and for a variety of reasons, supply and demand, I think it's a great place to be if you want exposure in that part of the market. So in the private markets, again, I think there's a shift towards capital. But the other thing that's happening is the massive advances in technology are creating it so you can have truly customized client portfolios in just a way that we've never been able to do. And so, we have a AI application called Go. It's a Go's optimization engine where you literally, a financial advisor, can customize a client's portfolios based on their individual goals as opposed to one portfolio. And it dynamically shifts based on the time frame and the risk of that particular goal. That kind of customization is real, and tax optimizing it too for the individual. That kind of customization is going to be a real win, I think, to investors, and it's enabled by technology.
When you talk about the AI technology, but also the 10 strategic partnerships or acquisitions, are there more to come? Is this the best way to really access new markets and new expertise?
I think it's important it's difficult, say, to grow organically in new areas. So our big alternative investments were in real estate, private credit, and secondary PE. The other area that we've said we think there's growth opportunity that we would be a potential buyer would be in infrastructure. And so, that would be kind of the last to fill out that product gap. Our acquisition recently of Putnam Investments brought actually traditional capabilities in the retirement and the insurance, which is an important channel for us that we'd probably been underrepresented in. So we're looking for those things that help to fill gaps that we have. And I think the good news is we probably have the broadest investment capabilities of any asset manager. And so we don't need to do any acquisitions. And now it's about finding ways. And we just recently had one of our private credit manager, the CEO, said, it was great. Franklin bought us in 2018, Benefit Street Partners, and you helped us with distribution. But now, because of AI and the cost of data and the expertise that's required there, we realized we would not be able to do that on our own. So being part of a $1.6 trillion platform that can invest in these and then have the boutique managers is a real advantage.
This really raises the point that I was getting to, which is some people are wondering whether the biggest players in the space have a disproportionate advantage because they do have economies of scale, because they do have that scope of data to use for the machine learning programs. Do you think that this is going to be how it sort of is that sort of smaller boutique fund managers have to partner with big funds, big firms, in order to survive this new era?
I mean, you definitely see distribution partners wanting to narrow the number of asset managers that they work with, just because it's complicated for a variety of reasons. You have to do the same amount of due diligence on a small manager as a large manager. And as I mentioned with AI, not only is the cost of external data very expensive, but the ability to train your own AI models by having more data in-house is a real advantage. And for us, having it in all different parts of the capital stack is a great opportunity and advantage. So I think that's where it becomes an important advantage to size. And then, honestly, things like blockchain. I mean, I'm a big believer that there's going to be new types of products that are introduced because of this technology. The work that we've been doing, we have a tokenized money market fund that we launched, our Benji app launched, I think in 2020, approved by the SEC. But for us, it's going to be the interesting follow-on projects. Now, we're probably not going to be material in earning money from this for 7+ years, but you have to get that knowledge today. That's harder for a small manager to spend their time in kind of an R&D on that.
Can we finish on stock picking, but of the sporting kind? Can you tell us the secret sauce to Brackets for a Cause to March Madness? I've got the details in front of me. You won the men's bracket in 21, tied for first place in the women's bracket last year. Why are you so good at this?
Hey, just like active management comes down to a great team, I have a great team at Franklin Templeton who give me great advice.
How big is the team? You've got 14
the
people
ones
doing
that
brackets.
feed into it are probably, and by the way, so many people like leverage their quant team. Mine's like the communication and D&I team, so it's about, I'd say that there are kind of 5 core people that help me fill it out.
Okay.
And I'm sure they get advice from a few others.
I'm coming to you for help next year because I'm absolutely dreadful at this. Jenny, this was great. It's good to see you. Got to do it again.
Thank you for having me.
Thank you. Jenny Johnson there, the CEO of Franklin Templeton. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Former crypto mogul Sam Bankman-Fried will be sentenced today over his role in the 2022 collapse of trading platform FTX. Bankman-Fried was convicted back in November of fraud and conspiracy, with a jury finding that he illegally used money from depositors to cover personal expenses like the purchase of luxury property. Prosecutors recommending a prison sentence of 40 to 50 years for Bankman-Fried. His family and friends urging leniency, saying FTX investors have largely recovered their funds. The ECB will allow Greek banks to make their first shareholder payouts in more than a decade, according to Bloomberg reporting. The last time a Greek bank paid a dividend was in 2008, ahead of the global financial crisis and before the country's debt crisis started in 2010. The bank payouts expected to come after Greek banks reduced their non-performing loans and increased their financial strength. Towns across America are preparing for a potential economic windfall with a solar eclipse scheduled to pass across the country on April 8th. The last eclipse in 2017 was lucrative for some states, with South Carolina's tourism department estimating a $269 million economic impact from around 1.6 million people traveling to see the eclipse. Rochester, New York is one city on the eclipse's pathway this year, with officials there anticipating as many as 500,000 people will visit in the hopes of seeing it. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, Secretary Yellen taking on China.
We've raised overcapacity in previous discussions with China, and I plan to make it a key issue in discussions during my next trip there.
That conversation up next, live from New York City this morning. Good morning. Quiet start to the morning. Good morning to you. Welcome to the program. Equity futures negative by 0.04%. No drama there. Yields are higher by 2 or 3 basis points. Let's call it 422 on a 10-year, 421.61. Under surveillance this morning, Secretary Yellen taking on China.
China's overcapacity distorts global prices and production patterns and hurts American firms and workers. We've raised overcapacity in previous discussions with China, and I plan to make it a key issue in discussions during my next trip there.
Here's the latest today. Treasury Secretary Janet Yellen sounding the alarm on China's industrial push, putting the issue front and center ahead of an expected visit in the coming weeks. Bloomberg's Mario Parker joins us now for more. Mario, great to catch up with you, sir. China actually snapping back, in fact, going first in the last 24 hours with comments about the Inflation Reduction Act. Those comments not unique, shared by the Europeans as well, Mario. How much tension is there between the US, Europe and China on this front?
Well, there's quite a lot of tension there. I mean, the fact is that you've seen Janet Yellen regularly now out in her visits across the United States kind of take aim at China and some of its economic policies. President Biden has also featured China rhetoric about China and its unfair what he describes as its unfair trade practices on the campaign trail as well. So no, tensions are very high, and and one of the issues and it's very bipartisan in Washington right now. Even as acrimonious as the political landscape is, there is bipartisan sentiment around these issues.
The geopolitical situation is acrimonious, but Xi Jinping met with a number of business leaders, and Steve Schwartzman, speaking to Bloomberg following meeting Xi Jinping, said the feeling I got is that, at least from President Xi's perspective, they were very open to attracting foreign capital. Is there any lane that we can see with this upcoming trip from the Treasury Secretary that we could potentially get something positive coming out of this relationship between Washington and Beijing?
Well, Annmarie, one of the things that Janet Yellen has tried to do is tightrope, right? So while we say that she's had more terse language toward China, and the administration has as well, it's also said that it welcomes healthy competition, that it wants to have a competitive environment with China, a fair and competitive environment with China, but not decouple from China, right? That's the key word there. So there's an understanding of just how dependent the global economic landscape is on China. But again, the U.S. is trying to make sure that it's measuring that some of that rhetoric there.
Mario, I'd like to change topics into what's going to be happening in New York City today. We have President Biden coming. He's going to be flanked by Obama and Clinton. We have Leon Panetta, who worked in these administrations of both former presidents, saying there's everything to be gained by Biden standing next to Clinton and Obama. How difficult, though, is this split screen going to be when the former president is also in New York to attend a funeral of a police officer that died while on duty?
Yes, it's a sad situation, first of all, but then there is politics. This is a 2024 election year, right? So we've got, on the one hand, we've got Joe Biden showing that he's essentially coalesced the Democratic Party. There were questions as to whether or not he could do that just weeks ago. Donald Trump, in the last 24 hours or so, has pointed to this fundraiser that Biden, Obama, and Clinton are holding in New York. So it shows that it has gotten under the skin of the former president. Meanwhile, with him visiting or attending that funeral, I mean, it does essentially bolster some of his bona fides on criminal justice, crime, et cetera. That's an issue that he wants to run on. It was also a liability for him, given, remember, about 4 or 5 years ago, when he was in office, he authored the First Step Act, right, that allowed for some of these people who have been arrested to get back on the streets as well. So this is a political liability that he's trying to cover up also.
When it comes to the campaign, and Biden's going to be having this huge fundraiser today, can you give us a sense of how far apart these two individuals are in terms of their war chests?
Oh, they couldn't be further apart. President Biden has about 3 times as much cash as former President Trump at this moment. Just alone, this event today, which is a star-studded event up there in New York, is going to raise $25 million, according to the campaign. That's more than double the amount that former President Trump raised in February, for example. He's cash-strapped. The split screen is the fact that 3 days ago or 2 days ago, former President Trump was in a New York courtroom asking for a reduced bond because he couldn't afford it. Meanwhile, his key adversary, President Biden, just has an embarrassment of riches right now.
Mario, I've got to ask this question. It just popped into my head. It seems quite obvious. Does Bill Clinton still help people raise money? Does that actually help them?
Bill Clinton does still help the party raise money, indeed. When you look at it, right, so you've got a few tiers in the party. Even though Joe Biden, of course, there's questions about his age. He's the oldest of the 3 men. There's the Obama coalition that he formed in 2008, carried in 2012. Then there's the Clinton. There are still Clinton Democrats out there as well, those more centrist Democrats also who remember those years or look back on those years fondly when he was in office from an economic and policy point of view. So you're essentially got 3 tiers of the Democratic Party represented there between Biden, Obama, and Clinton. You need all 3 for November if you're going to return to the White House for Joe Biden.
Mario, thank you, sir. Mario Parker on that big fundraising effort a little bit later on this evening in New York City. President Bill Clinton, Obama, and President Biden.
I mean, if people know who they are, they raise money. I guess that's sort of the bottom line.
Just wondering, quite a controversial figure in years gone by as well.
Since when has controversy been
not
a problem
exactly
in
the
politics?
person you call to help raise money?
This is true.
There was a lot of whispers about people in the establishment saying Biden should step aside. With this photo today, he's pretty much saying, I've coalesced everyone within the Democratic Party, to Mario's point, and they're all backing me to be president.
Everyone who came before.
Sure.
Not necessarily how the party is changing now. And I think that's part of the... Yeah.
So well said. Bramo, so well
Thanks.
said. Yeah, okay.
Let's move on.
Coming up, the CEO of DHL Supply Chain, Oscar de Bog, with the Baltimore port remaining closed. Plenty to discuss on that front. From New York City, with equity futures on the S&P 500 just about unchanged this morning, we're down by 0.02%. From New York, this is Bloomberg. It is a sleepy start to Thursday morning. Good morning to you. Equity futures just about unchanged on the S&P, on the Nasdaq too. In the last 24 hours, another close at all-time highs on the S&P 500, heading towards a fifth month of gains. You know the numbers since the end of October, a move of 25%. It's been quite a rally in the bond market. It's been a very different story to start the year compared to the back end of last year. 462.21 on a 2-year. Lisa, yields up 5 basis points this morning.
Are you not entertained? You just talked about how many 20-something record highs on the S&P. Bonds, yeah, they've not necessarily done so well. You've had a loss so far year to date and a total return level. But people have just moved on. They're basically saying, we enjoy the gains and we're going to keep them going.
Listen up, Russell Crowe. I have been entertained. It's you that's been bored over the first quarter.
Well, you sounded like you weren't that entertained. I'm just saying, a lot of people, it's like, another record high. What else is new?
Turn to foreign exchange. It's dollar yen entertaining for you, okay? 151.37. Unchanged on the session.
Is that entertaining to you?
Plenty of action in the last 24 hours.
True.
I'm just going to get to the top stories. Bramo just wants to get to the weekend. Under surveillance this morning, Fed Governor Christopher Waller given the strongest indication yet that the Fed could delay rate cuts, calling recent inflation data, quote, disappointing, saying he wants to see at least a couple months of better inflation data before cutting. The comments coming ahead of the Fed's preferred inflation gauge tomorrow morning, followed by comments from Chairman Powell later on that day. Governor Waller, this is from Neil Dutter. I like Waller, but I like Powell more. He highlights this in his note this morning. While he may be sharing it publicly now, this leads me to believe that Waller already made the case around the table at the March FOMC confab. We know how Powell's press conference went in that meeting. More weight for Neil on Powell than on Waller yesterday.
And it doesn't change anything to hear Waller say what he said, because he is a known hawk. And that, to me, is kind of the point. And actually, we can get the gut check tomorrow. If Powell has changed his tone, well, he's got an opportunity to say it when everybody else is home, because we're not going to be here.
Big chance following PCE. You're not coming in? Joining Mike McKee? Break down that data?
I don't know.
Bloomberg Radio?
I haven't gotten the call. Don't call me.
You don't want that call. Shares of the iPhone maker on high, soaring to record levels in Taiwan as demand for the company's AI servers overshadow any concerns about a sluggish recovery in the smartphone sector. The company's shares taking off in the past month, gaining more than 50%, despite slumping sales out of China for Apple's iPhone, and despite the fact that Apple's down double digits, Annmarie, year to date. The start to the year, if I'd said stocks will keep on rallying, I'm not sure you'd have Apple down as much as it is so far in 24.
It's been a downpour. That's what people are talking about, a downpour when it comes to Apple. There's the regulatory concerns on both sides of the Atlantic. And then, of course, it's these concerns in China. How do you compete with Huawei when it's a cheaper model? And we saw Tim Cook there trying to wave the flag to make sure. What I found interesting about this company specifically is that it seems to be all about this AI hype. But in a JP Morgan note, they say it's likely to remain their AI exposure at 10% to 12% this year, compared to 20% for its other competitors. But just seems to be all this AI hype, and Apple.
That stock, record high, Lisa.
I was looking at who their partners are, and instead of Apple being the exciting one, it's Hewlett Packard. I mean,
right.
that's how we're talking about right now. Hewlett Packard is the big order flow from Han Hai. So, the tables have kind of flipped.
Stock is down about 10% on Apple so far year today, which has just been amazing. Need to talk about difficulties in international trade. Details beginning to emerge on the scale of the rebuild required after the collapse of the Francis Scott Key Bridge in Baltimore. Officials estimating a replacement could cost at least $2 billion, while insurers are facing claims of as much as $3 billion for cargo on board the ship, according to Barclays analysts. One detail that remains unknown is how long it will take to reopen Baltimore's port and how that could affect supply chains along America's eastern seaboard. Joining us around the table for some insight is the CEO of DHL Supply Chain, Oscar de Bock. Oscar, good morning to you, sir. Thanks for being with us.
Good morning. Pleasure to be here.
Just how far down the supply chain do you expect to see some impacts, some ripples, consequences fall out from what's developed this week?
Yeah, the thing is the main impact of this one is more in the automotive roll-on, roll-off. It's less on the container part. Of course, there is a container element in there. Actually, we got a few containers on the ship as well, which we need to manage at the moment. But I think if you see one thing, and we were discussing that earlier, if you see one common theme in supply chain management over the past 4 years, is that ability to fast respond, that agility to fast make changes into how a supply chain is organized. And I think that's what you're going to see here as well. You're going to see a shift from container movements from this port to other ports. You're going to see. So I think while the impact to the port itself is dramatic, while obviously the event itself is tragic. But the overall impact on the global supply chain and the US supply chain, I think, will not be as large as you would fear.
You mentioned you've got some containers on the ship. Can you just walk us through how those conversations go in the last couple of days? What are communications like?
Yeah, I don't. Obviously, I've not been directly involved in the discussion on that. But I mean, it's a few containers, so it's not compared to the number of containers we have there. But one of the things is you need to make sure of how we get them released and how we can find alternative routes for them. How we make sure that our customers can plan the products that are in there, alternative routes, alternative plans, alternative products. So to keep those supply chains running. And I think the main, I was saying that probably of a last interview with Bloomberg at the time, where I said there is something around the corner in supply chains every time. We just don't know what it is. I could not have guessed that now we will be talking about obviously this event. And I think one of the main things that you see is that both our customers and ourselves, but I would say everybody working around supply chain, but actually also everybody working in other parts of our customers, is now far more attuned to having to respond, fast decision making, using data to make sure that we can have the alternatives and fast found alternative solutions how to manage the supply chain. Because I think this is one of those events that there will be happening.
Which raises the question of how much you have to sort of create redundancies inherent in your supply chains and in your system in order to be flexible to handle, say, a 2-hour delay because you've got to go a different route around Baltimore and get into Washington, D.C. Things that seem like they'd be disasters if I were traveling with my kids, but you have to manage and make the time seem the same.
Yeah, and I think that is a very important point where in the past, let's say more than 4 years ago, it was all about just in time, right? It was all about having the lowest stock levels possible, having the most efficient and cost-effective supply chain. What you now start to see is it's far more about the resilience of supply chains to make sure that they are organized in such a way that you can respond to these things. Because if you got your minimum stock levels, then obviously a 2-hour delay is actually dramatic. If you make sure that you build the supply chains in such a way that you can respond to that, it already helps. And I think that's something that you see happening at the moment, is that rather that let's say the minor cost is the main thing, now it is making sure that supply chain keep running, because many of our customers have now realized that supply chains are more about availability and making sure that you can continue to serve customers rather than only having minimal levels and minimum cost.
Does this make the just-in-time promise that so many companies were trying to offer less of a possibility or even a desired outcome, and more just the resiliency and the ability to be flexible, much more of the priority?
I think it's exactly, it's the availability of products which becomes far more the priority than purely the just-in-time, because what we all have learned is that the cost of a disoptimized supply chain because of an event is way higher than having a 5 or 10% lower or higher stock level. Now, obviously, with today's interests, stock levels have become obviously more relevant to reduce those. And that's, I think, where also the whole element of data analytics, converting into AI, converting into generative AI, come in as well, to make sure that we plan supply chains real time better and better on the use of data and also on the use of historical data. And there's a lot of historical data in the past 4 years that helps us to learn how you can respond to things.
What makes shipping so complicated is because Secretary Pete Buttigieg talked about this yesterday. There's no air traffic controller like there is for flying when it comes to logistics, when it comes to shipping. How can technology change that to make it more transparent?
Well, when we talk about port control, there actually is. So, for instance, in ports, there is a traffic control and a connection between the ports. So I think in shipping, it's more advanced than it makes it seem. And I think some of the elements that you could see in this event as well is that they have been able to respond pretty fast to avoid even more dramatic events because of a good communication that there was. So, but you're right. The use of data and is fast evolving. And one of the things that you see in general in the logistics sector is that the amount of investments that goes into the sector compared to 4 years ago is exponentially more. That means that the amount of innovation in the sector is exponentially more. And that you see that in data, in what we can do with data and what we can do with data analytics. You see that in robotic solution and other innovations. So therefore you see a fast evolvement. I would say internally, I always say that if you look at the last 4 years, the speed of innovation in the logistics sector compared to the 10 years before is mind-boggling. So it is. So that is actually which helps us to further increase and improve compared to the airline industry, where you see the opposite.
When you look at the communication between the government, Pete Buttigieg again today, being shippers and supply chain logistic partners, how has that communication been between the public and private?
In these type of events, I think the collaboration between public and private, if you take, for instance, the example between ports, because ports is in some cases public, some cases private, some cases the mix of both. I think there is a good interaction, but I think if you look at the speed within which that has evolved on the business side. So, for instance, now the interactions with companies is far more on sea level than where that before would be 2 levels down. Because CEOs and CFOs of our customers see the importance of being very close of what's happening in supply chains, because that's a differentiator in your profitability, your market share, your growth. I think gradually governments need to make that same step. To make sure that to understand how important it is for the success of the economy to really be close to the infrastructure, and that's not only hardware but it's also software, and those investments need to come from there as well.
You talk a lot about building out resilience. When we look at supply chains, particularly over the last few years, things feel quite fragile. From your perspective, are things more fragile or more resilient over the last few years post-pandemic?
I think they are to use different words. I think the capability to respond to the unexpected has evolved enormously. The only problem is that the unexpected happens more than in the past. So I think it has improved a lot, and that is because of bigger investments, the view of necessity of having those capabilities. But on the other hand, the number of events is evolving faster than the development of the sector. But I must say, if you look at if I talk about DHL, but if I also talk about the market in general and our customers, the capability of responding to things has evolved enormously.
So does that mean that you're able to charge more and that shipping will in general cost more because building in resilience is expensive?
Charge more and cost more are two different things, right? Because I think what you see is that because the professionalization of the sector has evolved, and therefore the value that it brings has evolved. So it might be that there is a higher price to pay, but actually the benefit might also be higher. So that doesn't necessarily translate in higher cost, because the efficiencies might be improved as well.
Oscar, thoughtful stuff. It's good to see you. Thanks for the update.
Thank you.
Oscar de Bock there, the CEO of DHL Supply Chain. Equities at the moment negative by 0.1% on the S&P. For an update of stories elsewhere this morning with your Bloomberg Brief, here's Yahira Hakez. Hey, Yahira.
Hi, John. While UBS cut its bonus pool last year by 14% after a tough year for traders and deal makers, its CEO now ranks as the best paid European bank boss. Sergio Aramati received $15.9 million in compensation for his first 9 months in the role. He was brought back as CEO in April last year to oversee the bank's rescue of Credit Suisse. UBS reported a record annual profit of $27.8 billion, largely driven by windfalls from the takeover. President Biden is set to raise $25 million in a single day as he campaigns across New York City. Biden is raising money alongside Barack Obama and Bill Clinton at a Radio City Music Hall event. The effort is designed to help expand Biden's already large cash lead over Republican presidential candidate Donald Trump. The showing alongside two former presidents giving Biden an institutional backing that Trump lacks due to his estrangement with big GOP names. The White House will require federal agencies to test AI tools for potential risks, plus designate officials for oversight. The Office of Management and Budget issuing a government-wide policy pushing federal agencies to implement safeguards by December 1st. The policy includes protections against privacy violations, discrimination, and more. Examples include giving travelers the ability to opt out of TSA facial recognition and allowing human oversight when using AI to root out fraud in government services. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, Governor Waller with one message.
No rush to begin cutting interest rates, no rush to cut the policy rate. I see no rush in taking the step of beginning to ease monetary policy.
There is no rush, apparently. That conversation up next. This is Bloomberg. Slightly negative, lower, down by 0.1% on the S&P 500, pulling back from the all-time highs of yesterday. Yields are higher by 3 basis points on a 10-year 421.80. The dollar stronger against the euro, 107.89. We're negative by about 1/3%. Under surveillance this morning, Governor Waller with one message.
No rush to begin cutting interest rates, no rush to cut the policy rate. I see no rush in taking the step of beginning to ease monetary policy. In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data.
Here's the latest this morning. Traders looking ahead to the core PCE data tomorrow at 8:30 Eastern Time, and comments from Chair Powell a few hours later for clues on the Fed's rate cut path. Luke Hickmore of Aberdeen writing this: Waller is a bit of an ignore and move on. Late last year, he was a lot more hawkish after the Fed pivot than Powell. We are penciling in June and September for cuts and then wait for the election. Then it all depends on the politics. Luke Hickmore joins us now for more. So, Luke, I've got to sort of skip to the end bit of that. It's good to catch up with you again, sir. Wait for the politics. Luke, what do you mean by that?
There's a lot going on at the end of the year, isn't there? We have, obviously, US presidential election, and the outcome of that is going to shape the whole of 2025 and possibly even the end of this year as well. If we get Donald Trump coming to the White House, that changes the fiscal outlook significantly. It could lead to tariffs. I mean, there's a whole raft of measures that he's been talking about and his team have been talking about that could change the inflation outlook as well and the Fed's approach to further reductions of monetary policy.
Luke, can they change the outlook and change policy before they see the policy come from Donald Trump? I'm thinking back to 2016. We all knew there'd be a big push for tax cuts going into 2017. We all knew that was on the table, and Fed officials were asked about it all the time. They couldn't change the outlook until they'd seen the policy. Luke, can they actually act ahead of time?
Well, this is why I think we get 2 cuts before the election, and then 20th of December. That's the review point. That's the point where they think, right, let's see what the actual policies are. What's he going to do in his first 100 days? What's the outcome going to be? You know, we're going into this with a 6.5% fiscal deficit already. So markets are going to be very, very, very keen to watch what happens with that. And the Fed, no lesser interest, let's be honest. So, yeah, 2 cuts before, 20th of December afterwards. And that's why it's really hard to say it's 3 outright for this year.
We were talking a couple of weeks ago or 2 weeks ago about a Liz Truss moment in the U.S. market. How close are we to proposals with whichever candidate wins that has to do with either more tariffs, fewer taxes, more protectionism more broadly? How much does that lead to a bigger disruption than some people are understanding in terms of inflation expectations and a potential Fed response?
Absolutely. These are the key points. So, is there the real risk of a Truss moment? Possibly. You just have to remember, this is the world's reserve currency. It's the biggest debt market in the world in every single shape or form. It's the biggest economy in the world. All of that mitigates a lot of those risks. But that doesn't mean the market's going to blindly fund the Fed, well, the federal government, into a 7, a 7.5, an 8, an 8.5% fiscal deficit. But they will give them time. They will let them come out and say, this is what we're going to do. And clearly, we've been hearing a lot of news about a better team behind Donald Trump in terms of getting the message straight and clear for investors. So I think we'll probably avoid it, but the risks have got to be rising as we get closer and closer to that point.
You know, we've been talking a lot about politics, and yet every person we talk to says it's too early to really make any kind of bets around it just yet. Do you think that there is some concern about this type of outcome baked into why the dollar isn't even stronger based on what we've seen in terms of the divergence of economic data?
I think it absolutely has to be. And I suppose to some degree, we've seen such a strong move out of risk markets over the last 6 months. That would be a natural point where you see a weaker dollar. And what we've seen is actually the dollar strengthening up this year quite a lot. So, yeah, it's not yet playing out as much as it could do in terms of currencies, but perhaps the early foothills, you're starting to see some of the impact come through. But I think separating it from what's been going on with risk assets remains very, very difficult.
Luke, I want to pick up this point. You said they need to wait to see the policies of the election, but they're going to be cutting twice before. Do you think they need to wait to actually see the policies, or you think they're waiting because they don't want to look political? And then in that sense, it kind of makes them political and not data dependent.
The whole debate on how political the Fed is perhaps a little bit beyond me, but I think from a pure fiscal monetary perspective, and how tight fiscal conditions are likely to get as we get into the summer, I think they need to cut before they risk staying higher for too long and actually hurting what has been a remarkable outcome for the economy in a no-landing, soft landing environment that we're in. I think the Fed are well aware of that. I think Jay Powell has made it clear in his recent speeches, and it's why we're leaning on June for the first rate cut from them. And the September one is possibly the political one. Things are still weaker. Inflation's come down a long way. Employment markets, so we will find that next week. But there are early signs of weakness there. And that could lean on a September cut as well. There's time to get 3 in, but why would you not wait?
You're calling it a super summer. June will see cuts from the ECB, the Fed, the MPC, in that order. Luke, I want to sort of lean on a comment we got earlier this week in the Financial Times from PIMCO's Andrew Balls. He was talking about where to take duration risk, and he said maybe beyond the United States, away from treasuries, because of the rate cutting cycle, these more convinced by abroad, and because of supply risk as well in the United States. Are they views that you would share?
Yeah, we've been longer gilts than we have US treasuries or ECB, German government bonds for the last 4 or 5 months. And I think this whole narrative that Europe's been particularly leaning on, that the UK's got sticky inflation, is really going to get challenged over the next 2-3 months. We can hit 1.5% inflation over the next couple of months before the bank cuts rates in June. So I think UK gilts, probably around the 5-year area. As you know, Jonathan, I'm a 5-year investor in government bond markets for the last year and a half. That's my sweet spot.
Luke, wonderful to hear from you, sir. It's been too long, mate. Luke Hickmore there of Aberdeen on the Federal Reserve, the ECB, and the Bank of England and the bond market too. Didn't get to Japan, so allow me to turn to these comments in Japan. We talk about the priorities in Japan, and I think what we've said so far this morning and over the last couple of days is that the policy priority is not the currency. It's a much bigger picture, which is a multi-decade effort to reset inflation expectations higher. And they don't want to undo it anytime soon. The Japanese Prime Minister, just moments ago, we have a historic chance to beat deflation. That right there, Lisa, is the priority.
And that right there is the reason why people aren't buying that this is a Japanese authority that materially wants to support the yen, because right now they will tolerate a weakening in the yen in order to defeat those decades of deflation. That's the reason why their message is falling on deaf ears.
Dollar yen at the moment at 151.37. Yesterday, really close to 152 at 151.97, prompting some more aggressive verbal intervention. But to get the policy to follow through in an aggressive fashion to take dollar yen maybe down to 150, down towards 100, you're going to need to see rate hikes, absent something happening on the other side of the currency pair, which is why Eric Nelson of Wells Fargo was with us this morning saying, yeah, sure, dollar yen could come back down. It's going to depend on what happens with the US dollar.
And they said that it doesn't really bother them. And that really is the reason why a lot of people are willing to push back. In previous instances of verbal intervention, it worked because people understood the conviction behind it. Here, people don't believe the conviction because of comments like what we just heard from the Japanese Prime Minister.
The Japanese Prime Minister just moments ago, historic chance to beat deflation. In the next hour on Bloomberg Surveillance, we'll catch up with Matt Miskin of John Hancock, Bloomberg's David Gura. Good to have David back. Tiffany Wilding of PIMCO, and Robert Davis, the CEO of Merck. Merck, quite a year so far, you know, in the stock market?
Well, they just came out with this particular drug that has to do with some pretty esoteric blood sickness, but that has a high mortality rate. I also want to hear about their GLP-1 developments.
Yes, with a different focus, I know.
Yes, but still, how do you sort of get into this world that's already been established in a unique way that also has some financial benefits?
That conversation about an hour away. Equity futures right now on the S&P, just slightly softer. From New York City, this is Bloomberg.
The Fed is telling us it wants to start the easing process in the middle of the year, and it's willing to do so even if in the first half of this year it's getting uncomfortably high inflation.
They want to cut. They still firmly believe that policy is restrictive.
It is clear that the Fed is on the path towards lowering rates in 2024.
The big risk that I'm concerned about, a sustained reacceleration in inflation that the Fed cannot deliver at some point in 2024 on rate cuts.
They need to be open to the possibility that inflation is sticky, and I think that changes their communication and the rate path.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the long weekend, live from New York City this morning. Good morning for our audience worldwide. Closing out Q1, the month of March, with a stellar month and quarter of gains on the S&P 500, reflecting on a speech from Governor Waller going into remarks from Chairman Powell tomorrow morning. Governor Waller a little bit earlier on yesterday evening, talking up the fact that maybe they should reduce the amount of cuts this year or push back the timing. We're in no rush. Some feedback in the last hour. Neil Dutta of Renmac, I like Waller. I like Powell more. We heard this from Luke Hickmore of Aberdeen just 10 minutes ago. Waller is a bit of an ignore and move on. Let's see how others feel about that this morning.
Seems like in the market there hasn't been a huge hiccup on the heels of the potential to cut rates fewer times or later. So ultimately this comes down to Jay Powell ratifying this tomorrow in a speech on a holiday when the markets aren't open. Does he sort of give credence to Waller as someone who's more of the mainstream rather than the hawkish extremes?
The question he's asking, I think, is the right question to ask, though. Unemployment's still below 4%. Inflation in some places is looking sticky. Not quite convinced we're on the path back towards 2. To use his own question, what's the rush? What's the rush to do anything?
He talks about how economic data, the slowdown has been sparse. Barely there, basically some soft retail sales. You have to think, though, now that this is public, to Neil Dutta's point, obviously it's something Waller probably said behind the scenes, but now that this is very public, how difficult is it going to be for Chair Powell to potentially herd all those cats? Because he does like to be someone who comes up and speaks with conviction that there is potentially consensus.
I think that consensus is coming together. If you just look at how the dots are grouping around one another, I know the median dot didn't move from 3 to 2, but it got pretty close, Lisa, and you can see the direction of the travel on the committee.
This is the Ferro scenario. I'm going to put it that way. The Ferro scenario is they sat around, they negotiated. They settled on June. That's when the cut's going to happen, and then there isn't going to be another one for the rest of the year unless the data materially improves.
Well, I don't know
correct?
about there's not going to be another one. I just think earlier and fewer might be the compromise.
Which to me then raises the question, are people really sincere in this narrative that if you get fewer cuts, but you do get cuts, it doesn't really matter, it will be supportive of risk? Is that really true? Because ultimately, if you really can't cut very much, if this is a shallow cutting cycle, we're going to be talking about much higher rates and potentially a much higher neutral rate. And you have to believe it matters if it's 5% or 3% that we're talking about for the Fed funds rate.
I'm going to sound like a Fed official. It will be highly data dependent, of course.
God. Who are
and
you?
we'll say this based on the incoming information and their current stance. They seem much more biased to one part of the mandate than they do the other. And I think the chairman said that explicitly in the news conference, that if you get a weakening in the labour market, it's ready to go. And I think on the committee at the moment, if that's where the consensus is, then the Doves win that argument and they win it pretty fast.
If that's the case, and this has been one of my big questions over the past 2 weeks, if that's the case, and I totally buy that that is the case, why are we not seeing more concern about higher inflation for longer? Is it that the market agrees that it will naturally disinflate, and we will get that even if the Fed moves at a much slower pace? This, to me, is the big question that has not yet been resolved in a market that seems flush with cash and ready to go.
You don't think gold's sniffing that out just a little bit, maybe?
Gold is, but then why aren't Treasury yields? Why isn't the, just the break-even rates that we're seeing 5 years out and 10 years out? It's actually a mystery to me, because if you're going to play this, gold is sort of an inconsistent way to play this. And there's some very direct ways that are not benefiting on the other side. I think it's a mystery if people really buy the message that seemed to be what I heard.
We'll get into that mystery in just a moment. Equities right now just about turning positive on the S&P 500 as Lisa tries to gloom it up. In the bond market, yields look like this. Up by 3 basis points on a 10-year, 421.80. Coming up on this programme this hour, John Hancock's Matt Miskin on market momentum as Q1 comes to an end. PIMCO's Tiffany Wilding weighing in on the Fed's next move ahead of more inflation data tomorrow morning. And Merck CEO Robert Davis on the company's latest FDA approval and the weight loss drug revolution. We begin with our top story. Stocks on track to end the quarter on a high. The S&P 500 closing at another record, poised for a 5th month of gains. John Hancock's Matt Miskin saying this. Looking back on this quarter, it was full risk on across asset classes and within equities. We are sticking to our bottom-up fundamental approach, but would be careful with momentum here as the trends can turn quickly. Matt Miskin joins us now for more. Matt, good morning to you.
Good morning. Thanks for having me.
Great to catch up with you in person as well. It's been a while. Let's get into this Governor Waller. Is it an ignore and move on? Do you agree with Luke Hickmore of Aberdeen?
I actually thought it made a lot of sense. I thought Powell in the press conference during the Fed meeting was, he kept saying over time. It's like when I tell my children to clean their room and they're like, oh yeah, over time I'll clean the room, and then it just keeps on getting more messy and everything else. Over time, you got to be thinking about this more with a priority. Inflation is starting to come back. And you said before, data dependent. I love that. That's a great way for the Fed to think about this. But if you're going to revise up your inflation forecast and you're going to keep cuts, that's not being data dependent. So they have a communication issue right now. And I think they're going to have a tough time navigating this because the markets are really dependent on them being dovish. And if they push back, I think it's going to be tough. But I think they should, because they don't want to fight this battle all over again later this year.
Always love your storytelling, so let's run with it. Let's say the clean room is 2%, and you're less convinced they're going to clean it anytime soon. When does the bond market start to get messier, which essentially is what Lisa is asking?
So we've seen some that are saying the position with for higher interest rates because of that. The long end of the curve would see higher rates if they let inflation run like this. But in our view, it's just you're seeing a lot of value in the bond market. Yields are already up. We're in an inverted yield curve. This is the longest inversion of the yield curve ever. So the bond market's a mess in a way, just trying to interpret this. In our view, though, we stay inverted. If anything, we get more inverted. We're actually on the other side. We think they're going to take longer to cut, but then they're going to cut more than the markets expect because something will happen. They've got to push back here. They've got to be strong. They've got to be that adult in the room and tell their kids to clean their room. It's hard. But right now, they're not doing it.
Well, they're not doing it. They're not being the adults in the room. They're basically saying, why don't you throw some more things on the floor? Because you know what, we'll get to it later. And this raises the question, what gives you conviction that that's the path that they're going to take if that's not the signals or the communications that they're giving? And markets are running with that, and they're not pushing back.
Yeah, I just think inflation coming back, growth, if our star, right? The stars of the sky. Like, you remember that analogy?
Yeah.
But if this is the neutral rate, why isn't the economy slowing? Why isn't inflation slowing? None of that's happening. It's hard to say that they're being really restrictive with high yield spreads at 300 basis points. They seem to be, they're trying to turn off the faucet, but the shower's still running. The liquidity is still coming into the market. And you've got to use I think that maybe this is a bigger picture conversation, but I think the Fed needs to be market-based and not academic-based or legal, a lawyer.
Got to jump in, Matt. It doesn't matter. This is who they are.
Yes.
Doesn't this scream buy stocks based on what you've heard in the last week?
So historically speaking, usually this is a time, late cycle, where the Fed is at what they think is the neutral rate. And you have to be careful because it does look good. You usually get this late cycle pop in risk assets as the Fed says, hey, we're going to think about cutting or we're not going to raise rates anymore. And then the tide goes out. Old Warren Buffett quote, when the tide goes out, you see who's swimming. But you want to make sure that you don't have that risk because if it's commercial real estate, if it's other things can break. And then all of a sudden the Fed's got to turn. And it almost seems like Powell might have something up his sleeve that's saying there's a risk here that isn't on the surface, that I'm playing this a little bit easier. And I wouldn't be surprised if there is something underneath the surface.
How frustrating is it to play psychiatrist to Jay Powell at a time where you feel like it should happen, but you think maybe he's playing games with us? Maybe in his head he knows something. I mean, this is sort of the level that we're at because people can't otherwise understand and draw the dots from what we saw in the meeting.
And they do the summary of economic projections and all this forward guidance. And back in the day, that was supposed to help because it was saying, hey, we're not doing much and we're just sitting here. Now it's almost hurting The fact that you're saying we're going to do rate cuts before gets priced in the market immediately. And basically, that was a rate cut. The way I think about it, almost like Fight Club, the movie, you don't talk about Fight Club. That's the first rule. Don't talk about rate cuts until you need to talk about rate cuts. Because if you're going to talk about it in advance, the market's going to say, great, I'm going to price that in. And then that creates the risk on, that creates the inflation impulse. And now we're going to have to deal with it all over again.
They also upped their own inflation target. So, we've been having this conversation with a lot of people about it's 2 point something that the Fed actually basically is targeting, no longer 2%. Maybe they're more acceptable of a range. Do you agree with that?
It's possible. I mean, after last meeting, I thought that. I thought 2 to 3. I mean, in the summary of economic projections, it doesn't take till 2026 that you see a 2.0. That's that over time. That's, hey, we'll clean up the room 2 years from now. But for then, it's going to be bumpy, But Annmarie, it's also about the energy sector recently. Oil prices are coming up. So if you had the stocks rallying, but you didn't have the inflation impulse, that's better. But I almost think about March Madness bracketology right now.
Sure.
Energy stocks were actually one of the best performers in the quarter. Oil prices up another 1% today. If that keeps going, they're going to be hitting gas prices coming up, inflationary impulse. And there's other things, disruptions of supply chains still going on. I think they're going to have to change their tune as the year goes on.
So what are you buying?
So we still have the high quality U.S. stocks. We're overweight U.S. versus international. We are up in cap. We're trying to find profitable businesses. We do not have some of the AI, the FOMO AI or the crypto, the mine, all that.
How hard has that been, though?
So AI-wise, NVIDIA has done pretty well. It has put on another $1 trillion in market cap last quarter. So we do have tech. We've been overweight tech. We like quality, so that helps, but at a reasonable price. On the bond side, we have been dragging because we've been higher quality, but we're willing. I look at high yield spreads at 290. I think it was last week. It was a great tweet, by the way.
Thanks.
Because we got to watch this. So the upside is 50 basis points lower is the tightest in history, or we could go 8 to 20% higher. And that's just another symptom of this market, is just how tight the spreads are. So we're not going after that. We have an underweight to high yield, overweight higher quality in the bond market. We're getting enough on the ball on that overweight to U.S. equities, overweight U.S. large cap, have some of the tech quality names. But frankly, we're sitting here waiting. And nothing's on sale. I mean, other than high quality bonds, but it's a hard trade because the momentum factor in equities is so powerful.
I love how many people don't have a Bloomberg terminal and rely on Bramo to get high yield spread updates. Super, super tight. But the way you talk about them is if they are a reflection of complacency and not a reflection of strength. Why do you see it as the former and not the latter?
Last 2 times they were this tight was 2007, 2021. The 12 months after those real tight levels, high yield was down 3% total return. So you got about 7% yield. Total return was negative in 2007. And this is, again, going back to that Warren Buffett quote of the tide goes out, it often looks the best before it turns. The risk on the sentiment has to be stretched to really feel the reversion. And so I still think, we always think about risk management. It's part of our DNA. But right now, as everyone else is going to this side of the boat, we're saying, hey, there's some stuff that's like higher quality, defensive parts of markets. That's actually what you should be looking at.
That's sensible. I think we always just think about, when I hear stuff like this, I always have to think about things from the other side. And I'm thinking right now, I'm listening to you, the Fed, just to borrow a little bit from Soros, I'll do it the other way around, the Fed can shape the events they anticipate. And if you get Chairman Powell coming out and establishing basically having a bias to respond to weaker economic data than they would higher inflation points, it probably makes weaker economic data even less likely because financial conditions are so loose right now. When you see credit spreads as tight as they are, the way I think about it is we were really worried about the maturity wall in 25, and we've just taken a massive chunk out of it in the first quarter of 24. A high rate's less of a thing to worry about 3 months into 24 than maybe they were at the start of the year.
Yeah, but you still have in all this communication, all this analysis, all this psychoanalysis of what Powell's thinking. But at the end of the day, they haven't done anything. So we're still doing QT. We still have 5.5. We still have this huge maturity wall. Russell 2000, 45% are not profitable. There's 50, 60% of those companies that have to refinance in the next 12 to 18 months.
Yeah.
So if they don't do anything, and that's why I actually liked Waller's comments. I was like, that's refreshing. Just don't do anything. Just let it go. Sit on it. Be patient. But But Powell does seem like he wants to cut. I think this is going to create more issues for him, and it's just a circular feedback loop.
Steve Rashida Mizuho just reminding us in the last couple of weeks, if there's a chairman that wants to cut, will the data cooperate? And that's going to be the argument that gets settled later this year. Matt, it's good to see you. It's great to catch up. Thank you, sir. Matt Miskin there of John Hancock. Equity futures right now just about unchanged. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hakez. Hey, Yahara.
Hi, John. Home Depot says it will buy SRS Distribution, a company that sells building materials, in an $18 billion deal. The world's largest home improvement retailer saying the acquisition will beef up its professional services business as it makes a push to win over contractors, roofers, and other building professionals. Home Depot says it plans to fund the deal with a mix of cash and debt by the end of fiscal 2024. Walgreens Boots Alliance narrowed its 2024 guidance even as it beat second quarter profit and revenue expectations. The drugstore chain citing a challenging retail environment and lower earnings due to selling nearly $1 billion worth of Cencora shares in February. Walgreens has been looking for ways to increase cash flow, including CEO Tim Wentworth's strategic review starting next month. The company will evaluate all of its assets, including retail locations, its primary care provider, and more. Treasury Secretary Janet Yellen is slamming China's use of subsidies to boost industry. Secretary Yellen speaking at an event in Georgia yesterday, saying U.S. manufacturing is facing pressure from cheap imports flooding the market. The comments ranging from green energy products to electric vehicles. Yellen saying this will be a key issue during her next trip to China, which is expected in the coming weeks. That's your Bloomberg Brief. John?
Yahara, thank you. Matt Miskin making me sound like a raging bull. If I did, that wasn't the intention. Up next on this program, the crypto world moving on.
We suffered a lot of damage to trust in the end of 21 and 2022. And getting that behind us is a good thing, period. I wish SBF well.
That conversation up next. Live from New York City, equity futures totally unchanged on the S&P 500 as we close out Q1. Equities going nowhere. Yields higher by 3 basis points, though. We've got a move there, 422.40 on a US 10-year. Under surveillance this morning, the crypto world moving on.
We suffered a lot of damage to trust in the end of 21 and 2022. And getting that behind us is a good thing, period. I wish SBF well. He is going to, serve some time and deserves to. But I think it's good for the industry to move beyond that. I think we have. I think, the face of the industry in some weird way went from a little kid in Bermuda shorts to Larry Fink.
Here's the latest this morning. Former FTX CEO and co-founder Sam Bankman-Fried facing sentencing over his role in the 2022 collapse of crypto trading platform FTX. Prosecutors pushing for a prison sentence of 40 to 50 years in what's been called the largest fraud of the last decade. Bankman-Fried's friends and family urging leniency, saying FTX investors have largely recovered their funds. What you're about to find out is what we do with new hires here at Bloomberg. We send them out into the rain, outside courthouses. David Gura back with us. David, it's good to see you, buddy. It's fantastic to catch up. Can you tell us what to expect later this morning?
Yeah, so we have seen the parents of Sam Bankman-Fried arrive, of course, both law professors at Stanford Law School. They came here, found their way to the door. The press has moved in. The hearing is scheduled to start at 9:30 this morning in Judge Lewis Kaplan's courtroom on the 26th floor of the building behind me. No phones allowed, no recordings. So we'll be kind of basing everything that we get on people's notes that they're taking and feeding out to us. But we're going to have a hearing where they're going to kind of go over this comprehensive report over what happened, the fraud that was committed by SBF, a bit of biography as well. They'll haggle over sort of what's in that. And then it'll get to this kind of crucial thing that you just mentioned a moment ago, which is the size, the magnitude of this fraud. And that's where we kind of see this fundamental disagreement. The defense saying, look, no harm, no foul, essentially. We heard from the bankruptcy proceedings that a lot of the money that was lost is likely to be recovered. The victims aren't going to be as in dire straits as we thought they would be. The prosecution saying, That's not the way this works. The fraud was committed and that needs to be punished. So the job for the judge here is to kind of look at the pantheon of fraudsters throughout American history. On the one hand, you've got Bernie Madoff, who was sentenced to 150 years in prison. The defense saying that's not the perfect analog here. A better one maybe is Michael Milken or Elizabeth Holmes at Theranos. They're asking, as you say, for a much shorter sentence, and we'll see where the judge kind of comes out with this. And this could last for a few minutes. It could last for a few hours. Folks expecting it's going to be about an hour, 2 hours long.
It's been pretty ironic, David, and it's great to have you back. Welcome back. Basically, we're looking at a rally in Bitcoin and crypto assets that has been so rapid that it has recovered a lot of the losses. How many proponents of Sam Bankman-Fried are there still in the area coming in who are Bitcoin enthusiasts, who are blockchain enthusiasts, versus some of the animosity and the distancing that we saw a couple of months ago?
I mean, you heard from Novogratz there a moment ago expressing his eagerness to move on here, and it is so astonishing how the crypto industry, if you can call it that, participants in this space aren't moving on today with the sentencing. They've already moved on, and after the verdict was entered, now about 4 or 5 months ago, the U.S. Attorney for the Southern District, Damian Williams, came out and said he wanted this case to send a message. It moved incredibly fast. I mean, Sam Bankman-Fried was arrested less than a year before that verdict was entered. Yes, it conveys a message. It's unclear sort of how forceful that is. I suppose the sentence will determine that. But how resonant is this other open question? As you say, Lisa, I mean, we see Bitcoin touching record highs. We see a lot of enthusiasm. We see this attitude that, this case and others, I should say, there are, other prominent figures in crypto who are facing legal issues of their own, including CZ at Binance. They've kind of cleaned house. They're ready to move on. So it is a funny moment in that sense. Prosecution trying to close this chapter, but this story, this crypto story, continuing. And as you say, its proponents very eager for that story to continue.
Yeah, I want to continue on that. What kind of domino effects could we see from this ruling today and some of the others that were wrapped up in this scheme he had?
That's a great question. I mean, I mentioned CZ and Binance. Of course, he pleaded guilty. He does face federal prison time. That's something that continues. You've got Alex Mashinsky also going on trial in the building behind me in short order. So, again, very prominent individuals are facing law enforcement in the coming months. But the really open question kind of pegged to all of this is what it means for the broader conversation about regulation and how crypto is regarded by this country and others. It's fascinating to me that it didn't serve as kind of a catalyst that many thought it would. There were plenty of people who thought this would be the death knell of crypto when FTX collapsed and Sam Bankman-Fried was arrested. That wasn't the case. There were others who thought this is going to really expedite lawmakers' efforts to come up with legislation that will kind of change regulatory structures in Washington. That hasn't happened either. So I guess what I'd say is a lot is at play here, Emery. Like a lot is happening as a result of this, but it's not leading to the kind of changes I think a lot of people would think would happen more quickly than they have so far.
Hey, David, you're an old friend. You're one of the very best, and it's fantastic to see you back on our screens. Thank you. David Gura there of Bloomberg, providing coverage on this story throughout today on Bloomberg TV and on Bloomberg Radio. It's a very odd situation. Typically, you think of frauds. You think of failures and a lot of people losing a lot of money. And what you're seeing in this is a lot of people being made whole because of what's happened in this universe over the last 12 months or so.
It reminds me almost of the Lehman claims, but that was sort of separate because there was actually assets behind it. It's sort of the enthusiasm for crypto outlived Sam Bankman-Fried's framework for it, which raises a question, does that have a material effect on the sentencing? Does that reduce some of the argument of harm caused?
Should it?
Well, yeah, the sentencing is about the fraud that was done, not whether or not the outcome was whether people lost money or not. So if you're looking at the fraud that was done, then it looks like he's not going to get a lenient sentencing, which is what his family and some of his friends are asking for.
If your friend has a Ponzi scheme of peanut butter and jelly sandwiches, there isn't going to be the same kind of sentencing than if someone has a fraud with billions of dollars, right? So this is sort of the issue that at hand here.
If you took money out of my bank account and put it in a triple-levered NVIDIA ETF, right, I'd still be pretty annoyed that you took money out of my bank account. Just because you were going to give it back to me, I'd be more interested in you stealing the money from me in the first place.
What if I gave you back, quadruple and quintuple your money?
Pretty sure that's not what's happening here.
Yeah, but if I did, then would you still be mad?
For us as friends, maybe not. maybe not. But I'm not sure that should apply to the leniency of this case. The court's going to decide
I think we've gone a little bit far.
Sure.
I wish you had done
Just
that.
think about you stealing money from me.
If you had taken money and put it
There's
in a
no way
triple-levered
that
NVIDIA.
you'd put it in a triple-levered anything.
But exactly. So if you had done it for me, I would say thank you.
So like some gloom stock, some like leveraged inversed
leveraged inverse
ETF on NVIDIA.
Apocalyptic.
Yeah, sure. No doubt. Economic data just moments away. An update on jobless claims in just a moment. Equity futures on the S&P 500 just a touch negative going into this print. Looking at the scores in the bond market, the scores look like this. On a 2-year yield, anticipating this economic data, yields up 5 basis points at the front end, up 3. On a 10-year, 462. On a 10-year, 422. 59. With your economic data around the table is Mike McKee. Good morning, Mike.
Good morning, John. Well, we're waiting for some numbers to drop. We get jobless claims first. They come in, surprise, 210,000. That was last week's initial number. We'll see what the revision is. On a continuing claims basis, 1,819,000. That is up by 12,000 from last week, but essentially noise in the greater context of things. The other numbers out at this morning are the GDP numbers, but this is the third estimate for GDP, so it isn't particularly meaningful. Comes in at 3.4%, though. That is significantly higher than the initially reported 3.2%. Initially it was 3.1, then it was 3.2, now it's 3.4. Personal consumption 3.3, up from 3.0. The quarterly GDP price index for the fourth quarter 1.6%, and the core 2%. Those are a little changed from the initial reporting. The one number I want to look up, and I know John wants to give you the market numbers, is the fourth quarter profit numbers we get in these numbers. And let me check that, and we'll be back.
I'll give you a quick sneak peek, Mike, of the price action. We bump a little bit higher, tick a little bit higher in the S&P 500. Equity futures just about positive. No big price action moves here whatsoever. If you go to the bond market, the 2-year yield was higher before the number. It's higher coming out the other side, up 5 basis points on a 2-year to 462. On a 10-year, up 3 or 4 basis points to about 423. In foreign exchange, dollar's been stronger through most of this morning. In fact, all morning. Euro dollar down to 107.90. Near session lows, that currency pair is down 1/3%. Jobless claims, Bramo, 210. I mean, what else can you say about the labour market? The unemployment rate is south of 4%. Claims are at 210. It's hard to sit here and scream this labour market's falling apart if jobless claims keep coming through around 200,000 every single week.
I'm old enough to remember a couple of months ago when people were saying that mattered, and actually the Fed was going to be paying attention to this and saying, well, the labor market's not cracking. We need to hold rates higher for longer. Now we're in a zone where nobody cares. This is not a data-dependent market unless it's bad data that affects stock markets. But if it's good data, it has no negative consequence with the potential for the Fed holding rates higher because they've told us they want to cut. And I think that is what we're seeing in this market.
Very true. Equity's just about positive. For a second look at this economic data, Mike, what have you got?
Well, what we're looking at here is basically increases in consumer spending, exports, and state and local government spending. That's what pushed the number up significantly. Residential fixed investment also up, which is housing sales. Of course, they've been so low that really haven't contributed anything. Current dollar personal income increased by $219.5 billion, so we're making a little bit more money. Personal saving, $809.2 billion. And I haven't run across the profits number yet. I'm still looking for that, but we'll get that for you.
Can you help me with something? First revision, second revision, third revision. Why all the revisions, and why are they continually going upward? It's like we can't get the economy. Fourth revision is coming. Why do they keep just getting better and better as we look back at what has happened over the past couple of months?
It's more source data. When they put out the first one, they don't have all the numbers in because it takes time to put together the trade numbers and the inventory numbers in particular. And so those get added into the first revision. And we get advanced numbers on those now, but they have to be massaged. And you get more information about all of these categories as the months go on. So by the third revision, they have it pretty close. There is a fourth revision that will come next year when they benchmark these things. And it's funny because if you look back at some of the turning points for the Fed, the data that the Fed had in front of it at the time can be completely different from what it looks like a year later or so. And that's one of the problems with being on the Fed that you don't have if you're being on Twitter or X. You can comment on stuff like, of course they should have done this, but that's not the number at the time that they were dealing with.
In 24 hours, we will have been sitting on inflation data for the last 4 minutes, PCE. We've had a lot of information which informs a view as to what PCE will look like tomorrow morning. What's your view of what that number's going to look like?
Well, I'm going to go with Jay Powell.
That's a good person to go with.
He said the other day that we're going to get a 0.3 rise for the month of February. So I have no reason to doubt the Fed staff's analysis. That would put us at about 2.8%. This is for core on a year-over-year basis, and that's kind of what the Fed is following. Chris Waller said the same thing last night, about 0.3. And as he pointed out, the October to December average was about 0.03 rather than 0.3%. So it's 10 times higher in January, and it would be the same this month. So that suggests that some progress has halted, if not gone the other way.
There are 54 estimates on the Bloomberg terminal, and only 5 of them say anything but 0.3%. I wonder why. Do you think that was just Mike McKean? Was that Chairman Powell, or can you just basically guess what PCE is based on what you got from PPI and CPI?
Yeah, you can. And that is, the inflation numbers are one of the better numbers for economists. They tend to get them very close. There'll be a surprise in one or the other that may push things a tenth one way or the other. But as you notice, there are only a certain number that say anything other than 0.3, but it's not a wide dispersion either.
True. Mike, thank you, sir. PIMCO economist and managing director Tiffany Wilding joins us now for more. Tiffany, let's start with the data tomorrow, and then we can sort of backfill and talk about jobless claims, which we just got. What are you and the team looking for, not just tomorrow, but ultimately what do you identify in the current trend coming into tomorrow and what things could look like in a couple of months' time?
Yeah, well, I think the bigger issue in our minds is just that after we did 2 quarters of 2% core PCE inflation, the third and fourth quarter of last year, obviously we got a revision, very small revision to that this morning. We think the first quarter inflation reaccelerated up to over 3%. So that's obviously going in the wrong direction for Fed officials. Christopher Waller talked about that in a speech last night. Powell seemed much more sanguine, but we think it actually will result in a lot of focus being on that second quarter core PCE inflation number. It has to come down, we think. It has to come down from 3, I think in order for them to, to get the confidence to cut here.
Governor Waller put forward the argument, Tiffany, that maybe they should go later or do fewer. Is that what you and the team are currently?
Yeah, we certainly think the balance of risks are skewed that way. I think the biggest argument that we would make is just that the growth has been quite strong. And we would argue, yes, there's some supply side improvements that are happening, but nevertheless, growth is above levels that we would think would be consistent with potential. And when you have above potential growth, usually that's tightening the labor market, not easing it. And of course, tighter labor markets will ultimately put some upward pressure on inflation. So, I do think the balance of risks here that they are on hold, at high levels for longer than they're maybe currently projecting. I think only one has to move for the median to move to 2 cuts this year. And that's certainly the way, we think things are headed.
Do you think, Tiffany, that Powell is actually data dependent? Or do you think that this is a Fed that has it in its mind that it would like to cut rates at least once ahead of this fall, just to get ahead of that and make sure that they're not being overly restrictive?
Yeah, I certainly think, when we listen to Powell, not only at the press conference, but his semi-annual testimony to Congress, it appeared to us that he almost pre-committed to getting things, to getting the easing cycle started in the middle of this year. And if you look at various Taylor-type rules, they would suggest that the Fed is already late to cut. I think they certainly have the cover to cut. And we've also been arguing, as long as inflation is this, quote, 2-point-something zone, it probably gives them the cover to go ahead and do it. So, getting ahead of the election, might be, something that they want to do in order to appear apolitical. But nevertheless, I think getting a cut in before the election, maybe they do fewer in the back half of the year as a result of the data.
Which raises this question. A lot of risk assets have rallied on the heels of potential rate cuts in the near future, even if it's just one. A lot of people say it just gets the cycle going and it makes them feel good and they want to go out and buy risk. How much does that actually make the expected inflation down the road higher actually given a little bit of a boost to some of the inflationary pressure that people are seeing around the edges, certainly in goods, but elsewhere as well.
Yeah, I mean, I certainly think there's a wealth effect here that's been important since the pandemic, obviously, because you had a lot of fiscal transfers, and I think that wealth effect continues to be important. And it is near term, should be boosting demand and on the margin should be inflationary. So, yeah, I mean, I think overall, continuing to manage financial conditions is something they're going to need to do. And I think that, maybe when they start to cut interest rates, to try to convince the markets that this is going to be slow, we could even stop for a time. We've been talking about the potential for this to be a mid-cycle adjustment. I don't think they'll ever say that, but the kind of language to try to keep financial conditions tight is probably what they'll continue to try to do in order to manage those inflation risks.
Tiffany, I just want to pick up on that mid-cycle adjustment. You remember the language of Chairman Powell a number of years ago. We talked about extending the cycle. Is that what this feels like to you?
Well, ultimately, the Fed is projecting that they will sort of slowly march back towards where they think neutral is. But of course, neutral is very difficult to understand and to estimate at any given point in time, right? We don't really know where neutral is until several years after the fact. And even then, the models are pretty wide in terms of their confidence bands. So I certainly think it's possible that they start to cut and the economy just reaccelerates a little bit. And that then stops them from kind of continuing to march back to neutral. I think over the longer term, we still think, demographics and lower productivity trends, probably make that neutral policy rate on a real level, kind of 0 to 1. But in the short run, we still have a lot of fiscal policy that's kind of sloshing around in the economy. The interest rate pass through to the consumers because of low rate, long duration mortgages has been relatively slow. So, those things can kind of keep the U.S. economy going, even relative to our developed market peers who have been a lot weaker.
Tiffany, just in this morning alone, we've had people come on the show and say we're early cycle, say we're late cycle, and now you're referencing mid-cycle. How confusing is it to really understand what cycle we're in, where we are in it, and how it's relevant to what's going to happen in, say, a year time?
Yeah, I mean, so I definitely think the pandemic has created a unique set of factors that have, really, made difficult forecasting, not only obviously for the economics community, but for market participants as well. I think that the key issue here is one of supply. It's how long can you get the kind of supply side gains that we saw last year to continue in the U.S. economy? And of course, that's going to, depend on productivity. We obviously saw a lot of immigration last year as well. I think there's reason to believe over the longer term that productivity could be great. AI, obviously is something that can be very transformative for economies. But that's I think economists are worse at forecasting productivity than they are recessions, and we know how difficult that's been over the last couple of years.
Tiffany, appreciate the update. Tiffany Wilding there of PIMCO on the latest economic data and what PIMCO and the team think about the Federal Reserve later on this year. Mike McKee, I want to give you the final word. There was a data point you were looking for.
Yeah, corporate profits, which is not just the S&P profits, but it includes private companies. So all in the United States in the fourth quarter, profits were up 4.1% after 3.4% in the third quarter of 2023. So there was progress made in the fourth quarter. Interestingly enough, almost all of it non-financial corporations, 5.9%. Financial corporations only were up 1.3%. And all the profits were domestically generated.
Interesting.
From the rest of the world, down 1.7%.
There we go. Mike McKee, thank you. Look out for Mike McKee tomorrow, Bloomberg Radio, breaking down PCE at 8:30 Eastern Time. Is that the short straw? How did that work out?
Short straw, yeah.
Short straw. OK. Well, I'll be tuning in, Mike. Thank you. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. A salvage firm is now heading to the port of Baltimore to recover the container ship Dolly and the collapsed Francis Scott Key Bridge. Federal officials telling Maryland lawmakers it will cost at least $2 billion to replace the bridge, including cleanup. There is still no timeline as to when normal port operations will resume, while insurers are facing as much as $3 billion in claims, with Lloyd's of London the most exposed, according to Barclays. Bud Light's comeback hopes are about to get dashed in the beer aisle. Major grocery chains are set to reshuffle their alcohol sections, giving more space to top sellers. Bud Light took a sales hit last year after a conservative-led backlash over its collaboration with transgender influencer Dylan Mulvaney. Owner Anheuser-Busch is expected to lose as much as 15% of shelf space to competitors Molson Coors and Constellation brands. Towns across America are preparing for a potential economic windfall with a solar eclipse scheduled to pass across the country on April 8th. The last eclipse in 2017 was lucrative for some states, with South Carolina's tourism department estimating a $269 million economic impact from around 1.6 million people traveling to see the eclipse. Rochester, New York is one city on the eclipse's pathway this year, with officials there anticipating as many as 500,000 people visiting. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, competition in pharmaceuticals.
For the most part, the trend in our sector has been to focus. To be diversified across sectors and diversified in science is really hard.
That conversation up next. We're counting you down to the opening bell, about 32 minutes away. Equity futures on the S&P 500 a little bit softer, down by 0.1%. Jobless claims came out about 17 minutes ago. Jobless claims 210,000. That is a strong labour market based on that economic number. Now, you can lift the lid on the labour market and find pockets of weakness maybe, but 210,000 historically exceptionally low on US jobless claims. Yields are higher by 3 basis points on the 10-year, 421.80. Dollar a bit stronger throughout most of this morning. In fact, all of this morning, 107.95, a break of 108 on the euro. That currency pair is negative by a third of 1%. Under surveillance this morning, competition in pharmaceuticals.
For the most part, the trend in our sector has been to focus. So if you look at some of those larger companies, almost all of them, save two, I would say, have focused down over the recent years. I think it's going to be the current trend in our sector. To be diversified across sectors and diversified in science is really hard.
It's the latest this morning. Pharmaceuticals up more than 10% in 2024, keeping pace with the S&P 500. Merck has been one of the top performers, up more than 20% year to date. The company winning FDA approval for a new drug that treats a rare form of high blood pressure. The drug's clearance coming at a critical time for Merck as it prepares to lose market exclusivity for its cancer drug, Keytruda. Merck CEO Robert Davis joins us now for more. Rob, good morning to you.
Great, good morning.
Can we talk about that approval yesterday? How much of a breakthrough is this?
This is really, we think, something special. The disease we are hopefully able now to really make a difference in is pulmonary arterial hypertension. And this is a rare disease. It's not a well-known disease, but it's a devastating disease. This is a disease that primarily affects women in the prime of life, age 30 to 60. Mortality rates of 43% in 5 years. So you can imagine impact not only to the patient, but to the family of people who otherwise are in the prime of life is really tragic. Thankfully and hopefully we'll make a difference in that. This drug now we're bringing forward, it's called Winrevair, is a biologic. It's a first-in-class medicine. It's a new mechanism of action called a activin signaling inhibitor. And what it actually does is potentially remodels the blood vessels, your arterial vessels, that allows them to open up. Because what PAH does, it causes your blood vessels in your lungs to thicken and narrow, which ultimately leads to heart disease.
How often do you take this? Every 3 weeks? How does this work?
Yeah, so it's a 3-week subcutaneous injection, can be done by the patient or caregiver. And so this would be something you would administer, we expect most people do in home.
I wish we could go into a whole segment about how you come up with these names, Winrevair, Keytruda. We can do that another time. I do want to get a sense, though, of this whole idea of how you got into this through an acquisition to partner with someone, and then what the importance is of looking beyond some of the mainstays like cancer, sort of that diversity that we were just hearing about. Yeah,
well, obviously, we are a science-led, science-driven company, and this came about because we were already starting to look into this space. So our cardiovascular teams within Merck were doing work in this space. When they saw the data from a company called Acceleron that had this asset, they came to me and said, we're excited. This can be a difference maker And that's why we moved on this. And it really now is a foundational element in our broader cardiovascular and cardiometabolic portfolio. So it is one where we see the value of diversification. Obviously, we're a leader in oncology. We're a leader in vaccines. We're increasingly moving into immunology and this move into cardiometabolic space, which is significant for us.
There are a lot of people who are listening who invest increasingly in healthcare. And all they want to hear about is, what's your solution for weight loss? Because that's really the reason why so many people have gone into the healthcare stocks and into the industry. You are working on a GLP-1 type of drug, but that's not for weight loss. It's for fatty liver. Why are you approaching this differently and not necessarily directed at the weight loss itself and more on some of the illness that potentially some of it can cause? Yeah, well, so the mechanism you're talking about, we have a GLP-1 glucagon dual agonist, and this is important because while it brings weight loss benefits, frankly, similar to what you'd see with Ozempic, our primary focus, as you point out, is fatty liver disease, which is really an untreated area today. And our view of this space is obesity is important, but increasingly it's the comorbidities around obesity. It's heart disease, it's diabetes, it's liver disease. And so if we can affect those and bring outcomes that benefit patients clinically there, they get the weight benefit. But then as you think about reimbursement, as you think about value, that's where the value comes to society, because actually we're making people more healthy than just losing weight. Is this mostly a coverage play? Essentially, it's easier for this to get reimbursed and insured. And that's one reason why, if you gear it at some of the illnesses, you won't have to get into the whole debate that's percolating elsewhere? Yeah, well, again, from a Merck perspective, it starts with the patient at the center. So we see this as a disease that needs to be dealt with. But yes, I think the benefit of this is if you can show outcome, if you can show that there's something beyond just weight loss, then your ability to be reimbursed and the ability to show value to society is different. It will be different.
But to your point, if obesity leads to so many other health issues, at some point, will insurance or the government even be able to put this under their plans?
We would expect so, yes, for sure. And I think you're already starting to see that start to shift. And it will be the outcomes-driven approaches that drive that. For sure.
We started this conversation by talking about this new drug that you've developed, got approval, stock ran away high yesterday. I was going through the cost. So the cost could be about $242,000 a year. I've always struggled with this, and I want you to explain to me, why is it so much more expensive in America compared to, say, the prices that I see for drugs abroad, in Europe, in the UK? What explains that difference?
Yeah, well, it's hard to do an apples-to-apples comparison. If you look at what drugs are as a percentage of total healthcare spend in the United States, they run about 14 to 15%. If you look across Europe, for instance, it's about the same. It's about 12 to 13%. So the reality of it is that healthcare as a total area, not just drugs, in the United States is more expensive. The percentage of cost of drugs in the United States is equal to what it is outside the United States. So it's hard to just take one element of the healthcare system and say, let's focus on it, not understanding the broader questions. If you're in the United States, the thing we benefit from, you get the fastest access, you get the most access to the most innovative medicine, driven by an industry that is based here in the United States and exports to the world. We need to look at the totality of what we see as really three elements you have to think about: access, affordability, but then also making sure you're protecting the innovation ecosystem that we value in this country.
Rob, we appreciate the breakthrough. That's for sure. In the last 24 hours, a major breakthrough. Thank you very much for being with us, sir. Robert Davis there, the Merck CEO. Just to flag the programming on Monday, this is what it's going to look like. RBC's Lori Calvasina, TPW's Jay Pulaski, Peter Chia of Academy Securities, and former Fed Vice Chair Randy Qualls. You'll be catching up with me, with Annmarie. You'll see Mike McKee tomorrow morning. You won't see Bramo. She'll be on a ski slope somewhere in the United States of America. Is that right?
And listening and parsing through all the data that we got, which I'm going to be, that's going to happen.
You'll have the headphones in on the way down the slope.
100%.
Mike McKee, 8:30.
What is it going to say? Yeah, exactly.
8:30 Eastern Time. Mike McKee on Bloomberg Radio, breaking down PCE. You're going to do the live feed of Chairman Powell as well. Yeah,
like while I'm going down the slope, I'll verbalize it. It'll be great.
You enjoy yourself, Bramo. Thank you very much. Stateside, I wish everyone a long weekend, a very happy long weekend from New York City. This was Bloomberg Surveillance.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. Danielle Collins is in the Final Four in Florida after she comfortably dispatched Caroline Garcia of France in straight sets. The former Aussie Open finalist remains unbeaten against Garcia in 4 meetings and will make her first appearance in the semis since 2018. Collins is looking for her first WTA title since lifting the trophy in Palermo 2 years ago.